Paribas in focus, better than estimated revenue and net profit, really exceeding expectations and jumping versus last year on equities and prime services. So that's a better story. LVMH, though, could be a weight on the CAC 40 regardless, Guy. We know the negativity around China and luxury.
There's a lot to digest this morning, so here we go. It is the opening trade. It is time to see how this all gets priced in, and we are anticipating a slow but potentially negative start to this morning. So the opening trade for the FTSE 100, negative. Not by much. We're expecting the FTSE down by around, let's call it circa 0.5%. The CAC 40, I think, could take a while to get open this morning, but we are anticipating that we are going to see a more significant move to the downside there, possibly circa 1% for the CAC 40. It could take a while to get things going. There's some big stocks out there this morning that we need to see details upon. So there you go. The IBEX is down by 0.4%. You got to price in what we're seeing with Santander into those numbers. The CAC is down by 1.3% at the get-go this morning. We'll see how the DAX opens in just a moment. But before we get to that, let's dig into these numbers a little bit more deeply and figure out what is happening within this market, Critty. What are we seeing?
Well, Guy, the earnings story certainly doesn't help, and then the heavyweights of the weighting that we don't see. Your sensational 6 not helping the picture at all. But your biggest index contributor to the downside on the Stock 600 right off the bat is going to be LVMH. You're already seeing a 4% drop there, and moving the index is your biggest weight, Anna, on the index as well. But it's not alone. You've got Novo Nordisk, you got ASML, you even have SAP as some of your biggest weights. So there is that European earnings read-through right off the bat, but there's also an American
and this is, yes, and in terms of luxury and LVMH, this is having a weight on the sector. So going into this, you might have asked, is the bad news in the price? Well, clearly not in the case of LVMH, but not for the sector as a whole then, it would seem, because LVMH is down by 4%, Christian Dior is down by more than 3%, Hermes down by the similar amount, 3%. We've yet to hear from Hermes. I think, as you said, we hear from them in the next 24 hours or so. Kering down by 2.9%, Burberry. So a lot of weakness coming through on this luxury space.
The breadth is horrible as well. So you've got 80 stocks up.
Yeah.
You've got 488 stocks down, 32 unchanged. The breadth is very negative this morning. We've been waiting for the German market. Let's see exactly what is going on there and whether or not we have a trade. Let me just get onto my DAX line. Yeah, it's still yet to open. I've still got a positive number for yesterday's session.
But you know where we have some positive numbers in active trading? It's in the IBEX. It's in Santander. It's one of your sole outperformers across Europe right now. Those shares higher by 0.7%. Not enough to lift the entire index, but definitely one of the only stocks green on screen, alongside Reckitt as well.
Yes, the household goods company operates in nutrition and similar spaces as well, and they are reviewing non-core homeware and their nutrition business and talking about strategic change. And that seems as if it's enough to send the stock substantially higher this morning, 4.5% higher, despite the fact that they've actually cut their revenue outlook in the more immediate future for full year 2024. They've cut that, but the market looking through that and talking about, committing excess cash to shareholders and what will the structure of the business look like after some asset sales, I suppose.
I think what's also important, and we should point this out as well, is there is a little bit for some of the green on the screen. I'm just kind of trying to pick out some of these. There, you are actually seeing a rebound in Porsche numbers. That took a major hit in yesterday's trade. This morning, at least the early indications, we are still waiting for the DAX to properly open, but at least on the Stock 600, you're seeing a move about 1.3% for those shares. So a little bit of a rebound.
I'm just trying to see what it is that's stopping the DAX from opening in terms of its performance, because you do have, like, single stocks are trading. It was Deutsche Bank. It's down by 3%. There you go. Deutsche has just opened, down by over 3% and continuing to fall. That was what was holding up the Deutsche, the DAX this morning. I was just trying to work out where it was, and now we know. Down pretty hard. So the market does not like the loss that it has delivered this morning. It's the first one in 4 years.
The banking sector as a whole, though, a little bit of a dip, But there is a much more mixed story, isn't there? And we talked to Santander. That stock is up by 1.2%, so really outperforming a falling market today on the back of their upgrade to guidance and some of the other strengths that we talked about. In fact, as you say, the IBEX is doing pretty well, and some of the Spanish banks are at the forefront of that.
Well, I think the way you just see it kind of net and the range here, I think is so staggering, is on the macro point of view. When you look at the CAC 40, down 1.5%, the IBEX is almost flat on the day. At least we're only 4 minutes into the trading session, but still pretty interesting that these are the earnings effect that you are going to see. And it's not just the European earnings effect as well. We still have to factor in the U.S. tech story as well. And I want to bring it back to that Tesla story, bring it back to the Alphabet story. We did hear from the CFO, Ruth Porat. I want to read a very important quote that she said. She said the most important element is search, as it continues to reflect broad-based growth across verticals that was led by retail. And the reason I highlight this is because this really showcases the fact that Alphabet is dependent, at the end of the day, on that advertising revenue. It is still very exposed to the cyclical movements that you are seeing in a lot of business investment, and that you are seeing, of course, globally, despite its massive investment in cloud. Remember, it is still not the dominant player in that, becoming, I think, third or fourth to Microsoft's Azure and, of course, AWS as well. But I'm curious how much you can macro this out, the message you're getting out of Alphabet, and apply it broadly. We have the perfect guest for that. Sonia Lau joins us around the table this morning, CIO at Legal & General Investment Management, with the coolest blazer, I have to say. I think every time you come on, you wear that, and I love it every time. Sonia, talk to us about this. We're seeing red across the screen. Earnings on both sides of the Atlantic are not looking good. Is this a panic moment for equity investors?
I wouldn't call it a panic moment if you consider that the weakness today is against the backdrop of course, a very long period of incredible strength across equities, globally, actually. And you've picked it up, right? There's a number of global themes that are impacting earnings, and they shouldn't be surprising. If you start with what's weighing on the Kakaron today, it's the China story. Now, Chinese economic data is not bad since yesterday. There has been trouble for quite some time. So to assume that the Chinese consumer might not necessarily continue with their incredible support for luxury goods, I don't think is surprising. What you're seeing today is finally the evidence in numbers. So the market reaction is actually quite natural to what should have been anticipated in that context. Now, the mixed picture across the banks, again, we should be very careful to generalize, because, of course, the business setup, the business mix of the companies that reported this morning is very different. So what is the strength potentially in Spain is very different to what drives Deutsche, because clearly the exceptional charge they had to take is not something we expect to be repeated next time. But again, you had the Deutsche Bank chart on earlier. You look at the one-year performance of the company, and it's a setback now. It might well be it's the lack of a further share buyback. You know, there might be immediate triggers on the day, but analysts and investors very clearly will look at the repeatable and sustainable earnings profile of most of these companies. But don't ignore the macro factors. And coming back to the MAX 7, I read a wonderful headline this morning, the magnificent correction, and we shouldn't dismiss it, right? Because we've been looking at these companies, and they've been driving the vast majority of the index level. But the expectations were for roughly 38% of earnings growth.
Yeah.
And you wonder, how sustainable is it? Are we ending up at 30? It's still a formidable number, but you need a readjustment process for what has been an exceptional journey for these companies.
So you said pay attention to the macro. There's layers to that. Is the monetary? Is it the fiscal? And within fiscal, I'm putting in the geopolitics as well. What drives the next 6 months?
To start with, it's all of the above. But as investors,
you got to pick one, Sonia.
No. You need to break it down, because you shouldn't try and put them all into one big picture. You need to understand what drives fiscal, whether this has then implications on inflation, and then you have the monetary reaction function to it. Hence, it will be the US election. If you consider the data we have been seeing, and we, of course, now had a surprise turn, so it is probably far more open than what it was prior to the changes over the weekend. But what we do know is that both parties actually are supportive of further fiscal expansion. Now, a Republican clean sweep, we know, would be more inflationary than a Democrat clean sweep. And with Kamala Harris now in the picture, this might be less likely. This is important to understand, because elections create a lot of noise. But only if you have an indication that it really changes growth and inflation, will the market react to it. the US election will be such a big driver of that understanding. And this is important for the yen you talked about this morning, EM currencies, because if the Fed is allowed to cut, that eases up the path for all these countries to react to it. A weaker dollar always benefits EMD. But you need to understand the reaction function across these, and this is where the election is your starting point to understand the wiggle room for the Fed.
And how do you position then ahead of the election, Sonia, when the polls are uncertain, they're in flux because we have new people in the mix, or one new person at least in the mix, and yet you describe a situation where on the inflation and monetary side there are going to be big differences between these two candidates. So do you position for one outcome or the other, or is it much more nuanced than that?
There's a third factor that you have to put in is valuation levels, because the asymmetry potentially on the back of what we might see is not, of course, the same. So there's been a lot of talk, of course, on spreads being at nearly 20-year lows in terms of tights. You have equity valuation where would be very mindful, and it's interesting to see the rotation we've already seen towards domestic stocks. But of course, with the closer we get to it, and we have to wait for the Democratic Convention, you will get more clarity on the actual plans that both parties will put forward. If the soft landing, and we have to take a step back, if the soft landing continues to materialize as it currently is, you might well see spreads where they are. So you have very little upside, but of course, unless you see further weakness in growth, you probably have just a sideways and you clip the coupon. But that would be reasonably attractive for equities as well, if you consider the potential rotation. I wouldn't try to position too much, because it's never been a good strategy to try to front run your thoughts on polls and the potential outcome. There will be sufficient time to get closer, to get more clarity. And as it stands, we have seen the polls shift quite significantly already. You might well wait and see. And as we see it today, you might see far more focus on the immediate impact and the understanding of where earnings will end up to supersede this with politics.
And what do you position for in China? Because there's a lot at stake for European corporates in China, and we've seen quite a bit of disappointment expressed in stocks, but also in commodity prices around the most recent meetings in China and the policy changes that didn't come out of that. Are you positioning for just more of the same, this sort of slow grind on the China story?
We are more neutral for the very simple fact, yes, the data is all bad. And we had the latest round in terms of credit growth, GDP. We know the imbalance that consumption still is not high enough to outpace or to overcompensate the decline in investment. But of course, Chinese assets are cheap. So you have to beware of the potential stabilization and hence more nuanced measures from the Politburo in terms of stimulating the economy. And that, of course, would then have not only implications for Chinese assets, but, of course, would potentially have a positive read across for all those companies, predominantly in Europe, that have large businesses in China.
If tech sells off and the market broadens, does the index go up or down?
That is, I think, a mathematical equation, because it depends on both sides moving, right? The concentration risk is such that it depends on the magnitude of the sell-off. And it depends even more so where earnings expectations settle. Because it's fascinating. Overall for the S&P, you're currently sitting at 10-11%. Yeah. As I said, that was starting 38 for the MAX 7. It was roughly 7.5 for the rest, and rather negative, slightly improving for oil and materials. Yeah. It's a fascinating divergent picture. And depending on where it settles, you might see the outcome for the S&P.
I have not been paid to be in a diversified portfolio. I have underperformed in a diversified portfolio for quite some time now. Yes. Is that diversification about to pay off?
Yes, our assumption is it is, and not just from an equity standpoint, but in general. Yep. Because, of course, the diversification didn't pay off. Equities would have done the job, right? So there's the story within specific indices, but there's a broader picture as well in the context of all the influencing factors we've discussed this morning, and how you think you can construct an asset allocation that will shield you from the potential asymmetry of eventual shocks or the implication of surprises from elections.
Okay, so just thinking about, therefore, what I do going forward, what does a diversified portfolio look like that's going to protect me from some of that uncertainty?
So the good old, fixed income equity, private markets will increasingly play a role because you will see a level of uncorrelated revenue streams that will help you a lot in that context. And if you look at duration, if you look at rates where they are, the benefit potentially is far higher than what it
We're confident that equities and bonds are going to be are going to be antagonistic.
Yes, for the time being. Of course, we had 2022 as the major driver against this, but proving the opposite. But over the long term and in the context of where we're currently operating, we still believe that there's benefit in diversifying that way. But, as I said, not fully. So it's not just classic 60-40. This is where private markets will play such a big role. So you're diversifying across a broader range of asset classes and more nuanced in the context of the individual areas. Because if you look at the steepness of curves around the world, right? Yeah. Big differences. So this is not one trade that you say, I'm buying the steepener, because that will not pay you any money. You have to be more nuanced where you see the opportunity set arising. And, in fact, we have been placing the steepener trade on and off because there is momentum behind it, but you have to be very targeted in what you're looking for. Absolutely.
Sonia, great to see you. Thanks for stopping by to see us. And fantastic jacket. Thank you very much indeed. Sonia Loud, CIO at Legal and General Investment Management. Thank you very much indeed. Quick look at the Core 6. We mentioned a little bit earlier on. There's some tough stories within the 6 this morning. As you can see, it is red across the board, but certain names definitely stand out, don't they? Look at what is happening with LVMH this morning. It is down by 5.5%. Some real weight on the CAC 40 as a result of that. But there's lots of stocks we need to focus on this morning. Lizzie Burden's been doing a great job bringing them all together. Lizzie, what are you watching?
Well, let me continue that story of LVMH, Guy, because it is bleeding into the rest of the European luxury sector this morning. Kelling, Dior, Hugo Boss, all down this morning. It comes back to people not buying as many lovely jackets like Sonia's, less demand for those luxury Louis Vuitton handbags. So Louis Vuitton sales suffering. There we are. Let's flip over to the banks as well. We can start off with the obvious stories that we would have expected off the back of the earnings. Deutsche Bank down 6.6%. We had the CFO earlier speaking to Wally Crook, of course, and they reported their first quarterly loss in 4 years. So this is what you would expect. You would expect BNP Paribas to actually be perhaps up because we had their report of profit rising in the second quarter, but actually they're in the red, lower 0.7% this morning. Santander is up. It beat expectations. It posted a record profit in the second quarter, so perhaps, as you would expect, higher, nearly 1%. But another surprise is UniCredit. They reported that they had a higher full net revenue and capital goals than before, profit topping estimates. So perhaps for UniCredit and BNP Paribas, actually it's more in line with the broader market weakness. Let me take you through some of the other corporate earnings stories we have this morning. We can start with EasyJet. I know the airline's been on your mind this week, Guy, at Farnborough Air Show. But actually, it's been a better story for EasyJet than Ryanair. EasyJet saying that airline ticket prices are holding up during this crucial summer period. And that in contrast with Ryanair shares, down 29% so far this year. For EasyJet, it's only about 16%, but up this morning, 7.3%. Reckitt Benckiser also reporting. They said it plans to sell off some of its home care brands, revive options for its infant formula business. Traders seeming to like that. Rémy Cointreau struggling this morning. They said that sales slumped in the first quarter. That demand for cognac in the US and Southeast Asia struggling. And Rémy Cointreau notably actually underperforming its rivals like Diageo and Pernod Ricard as well. So a difficult time for them. And just finally, a look at ASM International here, the Dutch chip equipment maker, of course. They've said that orders beat estimates on the AI boom, but unfortunately, their shares down this morning. Let me flip over finally to the car makers, because you have been talking about the Tesla earnings, and you've seen the underperformance there bleeding into the likes of VW, Renault and Stellantis. But actually, Aston Martin on the up this morning, higher 9.3%. Why? Well, they reported second quarter revenue beating estimates, and it's also been a positive story for Porsche. Of course, as you mentioned, Christy, they've had bad news on top of bad news this week with its EV ambitions and the supply issues because of flooding at one of its suppliers. But if we flip over to Porsche, actually, they've got some positive news this morning, reporting operating return on sales for the first half that beat estimates. So Porsche, I do think, also in the green. Back to you.
Thank you very much, Lizzie Burden, with the movers. And there were plenty of them also on the move. Some of the data coming through on Europe. And we're going to get a picture this morning, aren't we, around manufacturing and services and composite PMI data for the month of July. And this is interesting on two fronts. One, on the services side, where we see some outperformance versus estimates. But on the manufacturing, where once again we slump. And there had been a sense at the turn of the year that, maybe things were improving. And even if manufacturing is still in contraction territory, is it getting a little bit better at the margin? Maybe that was the story for China for the first quarter. And since March, it's really just been retreating once again. So again, bumping along the bottom when it comes to the manufacturing story.
It's interesting that the market reaction was fascinating. We just showed it there, but your dollar's still at 108. It kind of it's just unchanged now. And I'm curious how you even interpret something like that, especially when we're doing all this detective work of what's actually driving.
Waiting for the German numbers as well, I suppose.
It feels like it's a dollar story this morning.
Yeah.
The risk-off trade into the dollar, I think, is probably the driving narrative, certainly when it comes to the FX story. And I think this narrative changes very much as a result of these PMIs. I think the service number looks a little bit better. If you can't get a better services number going into the Olympics, I don't know when you can possibly get one. So maybe that's a factor in terms of what we're seeing here. It's also been a really strong summer for tourism, generally. We can take it back to what we're hearing from EasyJet. That has been certainly an area of strength, though Europe seems to be wanting to push away some of those tourists, which is an interesting strategy.
It's an interesting dynamic. And we heard from some hotel businesses, didn't we, that maybe the Paris Olympics, not quite the draw people thought it was. Here's the manufacturing story. That was the chart there showing France leading things lower. And that story of lower manufacturing over the last few months has been something that we've seen in other parts of Europe. So we will see whether we get that echoed in the German data when that comes through shortly. We're going to be building up to the Olympic Games, of course. The opening ceremony takes place on Friday. We have live shots coming to us, announcements expected during the second day of the IOC session. So this is the International Olympic Committee is meeting in Paris. They're expecting to be giving out the verdict on where future ceremonies are going to be held. And so this is
the winter. I think it's Salt Lake City is expected to get the Winter Olympics again.
There we go. So for the winter. So that's what's happening in Paris right now as we wait for the Olympics proper. Coming up, we'll be sticking with France though. LVMH sales growth slowed last quarter as sales in the region that includes China slid by 14%. We'll have more on that next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Welcome back to the opening trade. We're 23 minutes into a session that's being weighed down in Germany by underperformance in the banking sector from Deutsche Bank, weighed down in Paris by the luxury sector and LVMH. So let's go to Paris and think about what's happening there. LVMH shares are negative today after the French luxury powerhouse reported slow sales growth in the second quarter as wealthy shoppers in China reined in spending on pricey handbags and couture. Let's get to Bloomberg's Jennifer Creary, who has details of what's happening over at LVMH. So not an improving story then at LVMH. Jennifer, what stood out to you?
Yeah, so I mean, you can see the market reaction today. Pretty disappointing results. So LVMH, the key figure that we want to be looking at is organic revenue in its fashion and leather goods unit. So that's its biggest division. And that rose 1%. So missed analyst estimates of a rise of just under 2%. So a disappointing results. But if you think about the broader environment, luxury has been struggling for some time. So the fact that LVMH has been able to grow is something. But still a lot of weakness, particularly in key areas like the all-critical Chinese market.
Well, tell us more about those Chinese markets. I mean, the numbers I thought were fascinating. We go from 1% organic revenue down from 21% a couple of months ago. So much of that is coming from China. How long does that last?
Well, I mean, that's the critical question, right? That's what all luxury brands are asking, because we're seeing this across the sector. We're seeing this in other brands like Richemont, for example, the parent company of Cartier also saw weak sales in China, and LVMH too. So it's not just, the Chinese market in mainland China. It's also the traveling Chinese community, whether or not they're spending outside of that market. And we're still seeing some of that weakness still bleed through.
So we are seeing an effect this morning into the rest of the sector, and given the fact that some of this has been fairly well flagged, you could argue that's a bit of a surprise. What is new in this that is kind of affecting the whole sector, that is bleeding across into names like Christian Dior? Why are we seeing that this morning?
Yeah, I mean, it's a good question, right? So we're seeing a lot of this weakness come from what we call aspirational shoppers. So there are these shoppers that maybe make luxury purchases once or twice a year. It's normally at entry-level prices. And they're particularly affected when we see some of those economic headwinds. So they're the first to kind of pull back. What was really interesting from the results yesterday is we saw that sales for LVMH in Japan actually went up more than 50%. And the CFO on the call yesterday said that was because travelers, particularly Chinese travelers, traveling to Japan and taking advantage of that weak yen. So you can see some of that savviness in those.
But that hits margins, presumably. That's a margin risk.
Exactly, and that's exactly what the CFO mentioned yesterday. So while they are happy with that result, it comes at the cost of profit and margin.
Okay. Jennifer, thank you very much indeed. Perfect. Jennifer Crew, walking us through what we're seeing in terms of the luxury stocks this morning. That's one area that we are seeing significant weakness in, and it is certainly weighing on the European story. The other area is banks. We need to spend a bit more time talking about the banks. We're going to do that in just a moment. Santander, Deutsche Bank, UniCredit, they're all out this morning. We'll talk about them next. This is Bloomberg.
Every single thing I've done it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
German PMIs are very similar to French PMIs in a way, in as much as manufacturing is unbelievably weak in Germany. 42.6 is a truly horrible number for the German manufacturing sector. It's down from an already truly horrible number of 43.5. The survey was expecting a pickup. That has not happened. But the services number is strong, 52.0. And this is interesting in as much as the ECB is clearly watching services inflation quite carefully at the moment, and it looks as if services remains it's down, but it's still positive.
Yeah, and maybe this is the more information that the euro was waiting for then, Chrissy, as we were looking at this earlier on the French disappointment and asking, you know, it's not really moving the dial. There's a lot of yen action. There's a lot of dollar action going on in FX markets today. But this is just adding to the story around Eurozone disappointment, I suppose. And the manufacturing story, as you say, Guy, really echoing the French narrative that we are best case bouncing along the bottom when it comes to manufacturing. We really haven't seen a reassuring uptick.
You mentioned the euro. I want to mention the bond market as well, because we are seeing a sell-off across European bonds, except for into the Bund market, which is just coming off of this data as well. Only down by about 2 basis points for the German 10-year. But still interesting that's the market reaction that we're seeing. Why is Germany and France, why are the services numbers so
well, the German number is still relative. Like, it's 52.0.
Still growing.
It's still growing is my point. I think I'm trying to make it. But the expectation was for 53.3, which actually is a pickup. So we haven't seen that. Which I think is interesting in itself. I think the shock is in the manufacturing, and this is China. I'm assuming this is the kind of the Eurozone picture as well. Not seeing the strength maybe that we're watching out for. It was interesting. Rheinmetall was out with numbers this morning, which are quite strong. So parts of the German manufacturing story are still strong, but maybe this is therefore even more reflective of what is happening with the German manufacturing sector out of China.
There's that manufacturing chart then showing France and Germany now in that downward direction once again, having expected at the beginning of this year that maybe we were turning a corner. It certainly doesn't look that way. And so now we're seeing this China theme for Europe play out in the macro data, if that's what we're seeing here. But we've got this macro reference, and then we've got the micro.
And note on that chart, though, the notable outperformers, that orange line, which if you really squint hard, is the UK data, which I thought was interesting.
And we'll get an update on that a little while in
9:30.
Yes.
Is it 9:30?
An hour.
In an hour. So we'll get that number a little bit later on. Let's talk about how that reflects into what we're seeing with the European banking story. So you've got got Deutsche, BNP Paribas, Santander, UniCredit, all out with numbers this morning. Deutsche Bank suffering its first quarterly loss in 4 years, trading slowing. It's booking a charge tied to legacy issues at Postbank. That doesn't appear to be the story this morning, though, in terms of what is having an impact on the stock, which is getting crushed. So the bank's CFO, James von Moltke, spoke to Bloomberg's Oliver Crook. Take a listen to what he had to say.
Second quarter was absolutely a continuation of the first. So momentum in the businesses, on the revenue side, also just client engagement, market share growth. We're meeting our commitments to shareholders around expense management. So we've delivered the second quarter in a row at a $5 billion expense base. And we're managing the balance sheet and also capital ratios, essentially powering through the setback that we had, which was the Postbank litigation provision.
And that's looming very large over this quarter and potentially the next. So what can you give us in terms of an update, in terms of discussions, where that is right now?
Look, little to update. Basically, with the court has been going through the timeline that was laid out back in April. So we've provided a brief. We're waiting for the written conclusion, and then we'll react. I'm sure the claimants will react as well to that. It's very hard to assess really the direction of travel from here. We'll have to see what the judgment or the next statements from the court sort of tell us, and also what the posture of the claimants is going to be.
And is that 1.3 the sort of worst case scenario? Is that the sort of ceiling on? Yeah.
We've booked to the maximum claim. We have interest that accumulates over time, but we've essentially booked to the maximum claim.
And if this group of investors does win, does it open up a can of worms in terms of other litigation from Postbank?
Well, look, not on Postbank. I mean, there's one other sort of unaffected claim that we think is extremely remote. But no, what it does open up is some uncertainty in the German takeover code, which is one of the reasons that we've been fighting this case for 14 years. And so there's some interesting questions of law, because I think the interpretation being pursued here is very novel. And hence we're vigorously contesting the claim.
And so you have contested the claim and saying that Deutsche Bank has done nothing wrong. Do you think that indicates that the sort of regulatory system leaves room for investors to take advantage of this? And how does that bear on kind of your thoughts about taking over businesses in the future?
Well, it does introduce risk, and we think this transaction isn't necessarily alone in having the fact pattern that we went through, and hence I think getting certainty back into the German system about this type of takeover would be sensible. And for us, it's about contesting the claim, hopefully delivering some better news to shareholders around this. But managing it in the best interests of shareholders and also the legal matters at stake.
And what shareholders are also going to be caring a lot about today is how it's going to bear on your sort of buyback plans. And there was sort of some ambition for the back half of the year. It seems more remote. How is this going to bear on your payouts?
Well, look, we're really happy with how we've been able to manage through it in the second quarter. So with a CET1 ratio of 13.5%, essentially we more than offset the impact of the litigation provision. That sets us up well, I think, going into next year to continue delivering on the commitments we made to shareholders around a capital distribution trajectory. As you say, for this year, I think prudence would dictate that we step back from seeking a second repurchase authorization. We've already returned, $1.3 billion to 1.5, billion to investors so far this year, and so we think we're demonstrating an ability to stay on track.
CFO of Deutsche Bank, speaking to Ollie Crook. Ollie Crook joins us now. Ollie, is it that last point that's driving the stock lower this morning, and it's down and down hard this morning? Is it the Postbank story? Just walk me through the connection you're seeing with the various moving parts that we've had announced this morning and this big reaction in the stock.
Yeah, Guy, it's hard to sort of disentangle all of these things, but let's deal first with the sort of thing that is eclipsing everything else, which is obviously that write-down or that provision that they've put aside for Postbank. This is dealing with litigation that's been ongoing for a very long time. This is their takeover of Postbank back in 2010, and basically there are investors and shareholders in Postbank that brought a claim saying that they basically underpaid, Deutsche Bank underpaid for Postbank. So now they said early in April or in late April that they were going to put down this 1.3 billion euro provision to just sort sort of cover themselves. And by the way, as you heard from the CFO there, that is the maximum they can pay. So this has been sort of priced in for a long time. It's interesting now to see the stock down so hard, 8%, biggest loser. It was halted at one point due to volatility. The thing that it bears on in terms of looking ahead is in terms of the buyback. And you heard it from James von Moltke there that basically because of this provision and the sort of uncertainty around the Postbank situation, that they're probably not going to have a second buyback this year. However, he also said that their sort of general buyback plans and their returning money to investors will be unchanged. And to remind people, that is 8 billion euros through 2025. So that net figure over that period of time does not change. However, you do see it obviously reflected in the stock this morning, down more than 7%, almost 8%.
So that's the Postbank story. That's the buyback story. You look at some of their other numbers, and they aren't also looking very rosy. Walk us through some of the other parts of their business.
Yeah, Grady, they aren't looking that rosy, but they aren't looking that bad, honestly, when you look at sort of where you had expectations in terms of the market, whether it was their asset management union, that was close to in line, investment banking, private banking, corporate banking, all really kind of within expectations in terms of what had been priced in for investors. And in terms of the outlook, they didn't really change a whole lot. They had a little bit more on credit provisions. That obviously isn't positive, but it wasn't anything hugely material. The one thing that the market pays a lot of close attention to is FIC, is that trading over here at Deutsche Bank. It's a huge part of their business. And in the first quarter, they absolutely crushed the competition across the United States and Europe. This quarter, it was down 3%. So this is another sort of growth driver for Deutsche Bank, not doing so well. I mean, von Moltke was sort of comparing it to the year on year because they did very, very well last year. That was part of it. But that will be something that is not encouraging things generally. What I think was interesting is they were talking about how much slower this cycle has gone than anticipated, that actually net interest income, the tail on that is going to be longer, but sort of corporate loans and lending has actually gone a little bit slower. Here's what he had to say in terms of growth, generally speaking, in Germany and sort of for their clients.
Loan growth has been more sluggish than we would like to have seen. We'd been anticipating it a little earlier than now. And that's true also in Germany. We still have had a net decline in our mortgage book, for example, this quarter. Some of that's deliberate, some of that's sort of the market environment. Mm-hmm. I'd say the German economy has found its footing, and so we're seeing growth now. It's marginally positive, but we think accelerating now in the second half and into 25.
So the German economy finding its footing, I find interesting, just from the PMI data that we got just a few minutes ago, manufacturing really not picking up the slack so far. Maybe that starts to turn.
Yeah, we certainly keeping a close eye on that. We're also watching US politics and how that develops then, Ollie, of course. What did the bank have to say about that for their business, but also what clients are talking about on that front?
Yeah, so clients are very focused on this, obviously, and what a Trump presidency could potentially mean for Europe. Obviously, there's the question of tariffs that would be inflationary, would certainly reduce growth. So that is something that is very front and center for clients. He's saying that they're really sort of beginning to position themselves in anticipation of that possibility. What I also found interesting was also the EU elections. This apparently is also featuring very large in the mind of many investors and clients here in Germany. Remember, Deutsche Bank is really the big lender to Germany Inc. and industry in general. Here's what he had to say about the EU Commission and the new sort of von der Leyen Commission. Have a listen.
That Brussels in the second von der Leyen administration is looking at competitiveness, economic growth as core pillars of their program. To us, that's encouraging, and I think the economy, our clients are looking for that type of leadership. Also a reduction of bureaucracy and regulation. Those are all things that I think would stimulate growth here in Europe.
So for clients, really focusing on the European Commission and that focus on competitiveness, on industry, on defense, really front and center. And I think very often what comes out of Brussels doesn't really move the dial that much for industry. So what we hear from Deutsche Bank this morning is that they're hitting the right notes. The question is, can the Commission and Brussels play those notes for industry?
Okay, Oliver, thanks very much. Bloomberg's Oliver Crook with a full rundown of what we've heard from Deutsche Bank this morning. And it certainly has been a busy day watching the banking stocks, and that stock down by just over 7% this morning. Let's go over to the French banking sector. BNP Paribas in focus. The bank's equities traders made more money than their fixed income colleagues for the first time ever. CFO Lars Machenil spoke with Bloomberg's Caroline Conan in Paris.
I am cautiously optimistic of what you see in the Eurozone. Yeah? You see the growth picking up, you see there is demand, there are evolutions. So what you clearly see is the ECB is shifting. Actually, the whole economy is shifting. Inflation is tapering off. Therefore, the ECB is also reducing the interest rate. So the economy is picking up. And that's basically fueling a positive spiral.
We had a lot of volatility with this month of June until early July. Could you please tell us exactly what this volatility impact is on your business?
Yeah, no, if you look at, so there was, given the political, but not only the political elections in Europe and in several countries, that led to some uncertainty of what would happen. There was uncertainty about what the ECB and the Fed would do. So there was all that uncertainty that all of a sudden started to crystallize out. Yeah, you saw the ECB acting. You saw several indicators that were like the PMI and all the other ones that were evolving positive. And that's the whole evolution that you saw in all of the countries. So you saw these evolutions. You saw that what we had in the UK, you saw it in France, you saw it in Belgium, you saw it in many of those countries. And yes, there was some overall European volatility related to the elections that were going on all over the place. But that's just what it is.
Last week, the ECB kept rates on hold, and we had the president, Christine Lagarde, saying that the September meeting is wide open. What's your scenario? Do you still expect 2 rate cuts before the end of the year? And what impact could this have on your business?
Our stance is that there will still be 2 rate cuts this year, and so probably the rates will gravitate towards 3.25, so that's basically what we have in mind. I remind you that for BNP Paribas, the fact that the rates, if they are at 3, 2.5, 3.5, intrinsically, for us, that is fine.
That was the CFO of BNP Paribas speaking to Bloomberg's Caroline Conan in Paris. Let's get more on this bank then and the wider sector. Bloomberg's Jennifer Serrain joins us on set. Jenny, we had the details then of Deutsche Bank and how that's performing or underperforming, the stock down heavily in Frankfurt. We've talked to Ollie about that. We've got BNP now down by 1.6%. We just heard from the CFO, better than expected on revenue and on net, and equity's doing really well. So is it again the FIC disappointment? What stood out to you at BNP?
I think, in general with trading, it's never viewed as, I guess, positively by investors. This is not a business that kind of, powers through quarter in, quarter out. It's very lumpy. And so that's why you often see investors really wanting banks to kind of have kind of both engines running at all times. And so when you see a big beat on the trading front, it's just not something that investors like as much as when you see it on the lending front or something that's kind of more based on the fundamentals of banking, if that makes sense.
It's a bit lumpy, hard to value.
Yes.
That's always been the problem with having a big investment bank.
Yes.
What do I take away from what we've got today in aggregate between the banks, and what does it tell me what's going to happen in the second half?
I think there's a lot of one-off scenarios here. So obviously you've got BNP really powering through on the trading front. And then you have Deutsche Bank kind of getting a little softer on that front. And so I think it's kind of a tale of 2 cities in that way. And I do think, on kind of across the board, we actually did see some pretty sizable increases in investment banking revenue. So capital markets seem to have come back. Advisory really looking good. We saw that actually at the U.S. banks a couple of weeks ago. I do think the question now is that sustainable? Have we really turned the corner? Is the deal-making slump over? I don't think we have the answer to that just yet. So I do think that's one thing that investors are kind of looking at, trying to figure out, because a lot of this could just be, folks nervous about the U.S. election, pulling forward whatever activity they were going to do in the back half, and that kind of leaves the second half looking a little bit weaker. And so I think that's the big question that investors are wrestling with this morning is how much of these results are really sustainable, good gains, and how much of it is just kind of the one-off activity of the second quarter.
So when we do bank earnings, we do the classics. We do FIC, we do buybacks, we do advisory. We also talk about loan loss provisions. And the ECB is talking here about having demand to about 7 billion euros. That's less than what we expected, but still a pretty sizable amount. What's the logic here? What's the thinking?
I think, you see it with the ECB. We've really heard it from the Bank of England, U.S. regulators. Everyone is getting concerned about the size of the leveraged finance market and just how risky these loans can end up being. And so in a time when you've still got interest rates that are really high, even if they, might come down a little bit at the back half of this year, I think you're just seeing them trying to prepare for more hurt and more pain on that side of the market. And you want to they want to see these banks kind of preparing for that. And so you see them saying, we're wanting more capital. We want you guys to pull back. We want you to be paying closer attention to these clients. And so it'll be interesting to see, how much this really impacts how the banks go out and court these guys. So far, we haven't seen much of a change. You still see these banks pretty hard going after these sponsors and private equity clients. But it'll be interesting to see if this really pans out and ends up causing a bigger pullback from the leveraged finance market.
It's so interesting we talk about them being so risky because back at Super Return in Berlin, all the private equity folks were saying an encouraging sign in Europe is that the leveraged loans market is outperforming in a way that it isn't in any other part of the world. I think we have to leave it there. But Bloomberg's Serene joining us to break it all down. We thank you so much. Coming up on the program, the aerospace supply chain is recovering. At least that's the view of GE Chairman and CEO Larry Culp. Guy Johnson had the interview there. We're going to dive into that. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
If you look at our order book in the second quarter alone, nearly 40% year over year. We see our utilization of the fleets, both the mature fleet, which we power with the CFM56. That has been steady, an engine that folks thought might begin to fade. Our newer generation technology, the LEAP engine on both the 737 MAX and the Neo at Airbus, that's probably up 4 points in terms of share. So our utilization could not be higher. Even just looking at the third quarter here, we have probably 90% of our third quarter projection in backlog today with respect to parts. So in terms of the demand signals we're seeing from our customers, things are strong.
So the hours being flown are going to remain consistent, you think?
We believe so. Okay. And going forward, they're going to increase.
That's the kind of the older story. That's the existing fleet that's already out there. As you say, the maintenance story is very strong. The margin off that is very, very strong. The story certainly at the Farnborough Air Show and all the air shows recently and throughout this industry has been what has been happening with the supply chain. Airbus lowering its guidance for the year, talking about engines within that guidance. Is the supply chain story getting better or is it getting worse?
Guy, I'm strongly of the view it's getting better. It's really all about the rate of improvement.
Right.
And what we shared earlier today with investors is that we didn't have the output that we had anticipated in the second quarter with our newest generation engine in particular, with our LEAP engine. But we're going in using our flight deck, our lean operating model to help our suppliers help us. Jointly problem solving, really understanding constraints at the point of impact. And we saw tremendous results from that in the second quarter. Didn't translate into as many deliveries, perhaps, as our airframer customers would have liked, but we saw 2/3 of the suppliers that we worked with improve their output to us by nearly twofold. So that's encouraging.
Just kind of talk me through what's happening. So originally the guidance was for a 25% improvement for that engine. Then you went, I think it was in April, you were kind of 10, 15. Now you were at kind of flat to 5.
Exactly.
That feels like it's not getting better. You're telling me that it is, though below the surface, getting better.
It's not getting better at the rate that we had anticipated.
Yeah.
But it's getting better if you look at the sequential trends. And that, from an operating perspective, that's all that really matters.
The chair and CEO of GE Aerospace, Larry Culp, speaking to me yesterday. This is a business that has kind of spun off everything else. We're left with the jet engine business. And that jet engine business is good and bad in so many ways. You've got really strong demand right now, but the supply chain story continues to be a real issue. He's saying it's not getting better as quickly as we anticipated.
Is this a sector still impacted by post-COVID, by the
Yes.
sort of legacy of COVID, which in itself is phenomenal?
Yeah.
We're 4 years on.
It's extraordinary. So a lot of people left the industry. They basically, remember, the aviation effectively shut down, and they have taken a long time to get it back up. They also lost a lot of people. But it's taking a long time. And it was interesting, I was talking to Guillaume Faury at Airbus yesterday, kind of about this moment yesterday. He was saying we've still got a couple more years, like 2 more years before this is sorted out. This is a time when you're seeing huge demand.
So where does that show up? Does that show up in the backlogs for the Airbuses, the Boeings? Does that show up in the capacity constraints? Like, where's the biggest...
It shows up in the fact that a lot of airlines are flying very old airplanes. And that is...
Safety concerns.
So, well, it's not that. It's just... If you look at GE's numbers yesterday, they were good. Why were they good? Because you make a greater margin off servicing an aeroplane, providing parts for an aeroplane, parts for an engine, than you do in building a jet engine. They effectively book them at a loss when they sell them. So if they're doing all kinds of things on maintenance, that's great right now. But ultimately, if we're going to see improvements in efficiency for this industry, you need these new engines.
Just like lots of sectors trying to tie customers into some sort of servicing contract rather than just the sales and then let it go. Quickly, should we check out what's going on in the luxury sector this morning?
It's an interesting point that you made on the airline space, that it's kind of a post-COVID story, because that's the same story I feel like is China. We're waiting for a recovery there, and I think it's the very story that's weighing on the luxury sector this morning. One of your biggest index weights is going to be LVMH, down about 5%. You're seeing it bleed into the others. Kering, for example, down about 4% as well. Even Hugo Boss down about 3.8%. You are seeing luxury take a hit and drag down not only the stock 600, but drag down specifically the French index.
And we're seeing the German bank Deutsche Bank under pressure over in Frankfurt, down by 7.6%. It's not exclusively there, though. We are seeing others in the banking sector under pressure as well. So BNP down 1.9%, UniCredit down 2.3%, and they're very different stories. There does seem to be some disappointment on the timing of returning cash to shareholders around Deutsche Bank. So that's certainly something we will watch. I don't know about you guys, but I've just had a look at what is coming up tomorrow on this program, and I'm about to go for a lie down.
Yes, there is a lot going on.
In preparation.
Well, a lot going on, but some really great interviews. We're going to speak with the CEOs of Julius Baer, Anglo American, and Lloyd's Banking. There's a lot of questions right now in M&A for all three of those companies. We talked a lot about it today as well. Beyond the banking sector as well, we've got conversations with the AstraZeneca CFO, the CEO of Roche, and the Unilever CEO as well. So after our lie down, we will have some really good conversations.
We'll have 2 hours to fit all of that in.
Yes.
It's going to be a busy morning. The European earnings season is fascinating. Not everybody is down this morning. There are companies that are having a good day, but it's definitely a morning of tech weakness and luxury weakness. I'm going to pick it all up, continue the conversation. The Pulse is coming up next. We'll talk more about what is happening in the luxury space. Got lots to talk about this morning. Busy morning. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Tesla profit falls short again. Elon Musk calling for investor patience. Alphabet CEO asking investors to wait a little longer for some results from AI investments. Big story out of Europe this morning. Deutsche Bank plunging after suffering its first quarterly loss in 4 years. This as it looks to a charge related to Postbank. But BNP's profits rise. Santander lifting revenue guidance. We're going to talk about all these European banks. We'll give you a little bit of a roundup there. Plus, the other area that we're seeing weakness in, LVMH falling as China's luxury slump hits sales of expensive fashion and drinks. We'll talk about that story throughout the program. We've got some great guests lined up on both of those two issues. I want to talk to you about how this is translating into the market, though, this morning. Let's deal with the cross-asset story, because you've got European stocks a little softer this morning. You can see the stock 600 down by 0.7%. US futures are also softer as well. We need to price in what's happening with Tesla and in Alphabet and what we're seeing in tech more broadly. LVMH is down by 5 1/3, let's call it that. It's down by 5%. But Deutsche Bank, look at Deutsche Bank, down by 7.74%. So weakness in Europe coming this morning from the banking sector and from the luxury sector. We need to talk about both of those sectors. Let's get started with that.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to the Pulse. I'm Guy Johnson. Francine is out today. We've got some data that's also out today. So let's talk about what we're seeing with the numbers. We've already had French PMIs. We've now got German PMIs to digest. And then we get the aggregate Eurozone number. The manufacturing number, a little weaker than anticipated here, folks. 45.6. That's down from 45.8. It was expected to pick up. Look at the German number. It is ugly this morning. The services number, 51.9. Again, that's softer than anticipated, but still at least in positive territory. That takes the composite number to 50.1, i.e. absolutely flat between contraction and expansion. And we were expecting, again, that number to be a little bit more positive. So that's the picture. You see the reaction in the euro this morning. I need to talk a little bit about what's happening with the dollar more broadly, though, because the dollar is a risk-off story this morning. You're going into the dollar as a result of that. Why are you seeing risk-off? Well, you're seeing risk-off because you've got Alphabet numbers, which didn't go down very well last night, despite actually being better, and the Tesla numbers really weren't pretty at all. So let's take a quick look pre-market at what those stocks are doing, just to give you an idea of what they look like. And as you can see, it's not exactly a magnificent start to the earnings season for the Magnificent Seven. Alphabet's a little softer, down by 2%, but look at what is happening with Tesla this morning. It is down by circa 8% as we head into the open of US trading a little bit later on. CEO Elon Musk, obviously the front man for this in the earnings season, and patience was once again apparently a virtue. He was talking through his plans for the Gigafactory in Mexico, and this is a political story as well. This is a Trump story, and apparently that is on pause.
Giga Mexico, I think we need to see just where things stand after the election. Trump has said that you will put heavy tariffs on vehicles produced in Mexico, so it doesn't make sense to invest a lot in Mexico if that is going to be the case.
Elon Musk needing a little bit of an energy boost, you kind of felt on that call last night. We have got lots to discuss, and we've got the perfect people to do that. Joining us around the table this morning, Joanna Kirkland from Schroders. She's going to give us the big picture story. What do you do with all of this? How do you fold it into your portfolio? Let's talk about the details of what we learned last night and work our way through the Magnificent Seven. We've got Tesla and we've got Alphabet. Critty's continued with me after the last program around the table. Craig's back to talk about it. Craig Trudell, our car czar. Craig, let me start with you. There was lots not to like last night, but was any of it really new? The robo-taxi we're going to have to wait for. The robot we're going to have to wait for. Investors are being asked for patience once again, but it kind of feels like that patience is wearing thin.
Well, it's a bit of a, live by the robo-taxi, die by the robo-taxi here, where, the anticipation of that unveiling, despite the fact that we are talking about just prototypes, it's very unclear just how, ready this product is for prime time, how soon regulators are going to give their blessing. But this is something that really just drove an incredible rally in the shares. The last time this company was reporting earnings, they were down more than 40% for the year. They had come all the way back from that, largely, I would say, on the basis of optimism about autonomous vehicles and AI. Musk was really successful in really sort of tethering the stock to, the AI optimism. And, we've seen now that when Bloomberg first reported that this event was going to be delayed, the stock had its worst day since January. It looks like we're headed for another rough day on the basis of maybe putting some more risk onto that opportunity.
Critty, the funny thing about the Alphabet numbers is they were good. But the AI story we're talking about with Tesla is one that we're going to have to wait for. The call was about AI. It wasn't about sales. It wasn't about advertising. It wasn't about cloud. And the market seems to, because of the way the stock has kind of been pushing higher, the market needed to hear a positive AI story.
So good numbers, but not good enough numbers. And I think Alphabet in particular is really trying to use Craig's exact phrasing, tether itself to the AI story, but it's not an AI story yet. It's not even a cloud story yet. It is still an advertising story. It is still a YouTube is weighing on the numbers kind of story. And the advertising numbers were interesting. They came in at about 11% a jump in revenue, but that's a deceleration from the previous quarters, at least the analyst community pointing that out. I think what was interesting is, and I think the context is important here, Microsoft Azure and Amazon Web Services has the dominance in this market. Oracle's trying to break into it. Alphabet's trying to break into it in terms of market share. They're throwing a lot of money at this, and they're not able to get there yet. And that's where it's very clear. They're saying, be patient, look at the future, we're going to grow. But again, when it comes to the actual metrics of what they're up against, they don't have much to deliver just yet on that front.
So we need more patience. That seems to be the overriding narrative.
Channeling Jay Powell.
Yeah, exactly. Just wait. We'll be data dependent. Unfortunately, the data maybe not from these tech companies looking that good. Guys, thanks very much indeed. The Tesla, the Alphabet story. Obviously, we're going to continue with the big tech story. I want to hear from NVIDIA and see exactly what it has to say. There's a lot of spending going on. Is it, to Creedy's point, actually delivering? Johanna Kirkland, co-head of investment and group chief investment officer at Schroders, joins us now to give us a take on all of this. If I've wanted to outperform in my portfolio over the last few quarters, I've needed to be long big tech. That has been where the outperformance has really come from. Has that period come to an end? And if so, as an investor, what do I do with that?
Well, I think, certainly over the last few quarters, that's been the epicenter of return. But there have been a lot of other return opportunities across the world, actually. So generally, we've favored equities. And, Japan's been a great story. We had a bounce in China. There has been a lot of other things going on as well. And I think at this point, it's again about focusing on the fact that nominal growth is still quite strong. Rates are coming down. So the big picture for equities is still supported.
But if I've had a diversified portfolio, I have underperformed over the last few quarters. The data's pretty clear on that. Are we going to see a diversified portfolio doing better now?
Potentially, because I think the valuations are very supportive as you go down the cap spectrum. There's a lot of pent-up return potential. We've seen that rally in US small caps. We've also turned more positive on UK mid caps. Now we've got a bit of political stability. So yes, absolutely, the valuations there are still supported.
So what is the potential? Let's take UK mid caps. What is the potential upside there? How the gap is enormous. The spread is historically large. How much can that close?
Well, I think the key thing is not to try and go long mid caps versus large caps necessarily. We're generally overweight equities. I think that's the key. And again, it's about a very benign growth environment still. We're still in a soft landing. And I think people are still underestimating the benefit of that growth environment for equities more broadly.
But the UK is a beacon of stability right now, ironically?
It is, ironically, but I think we just went into our instability earlier than everybody else, and we're sort of coming out the other side. And of course, international investors are attracted to the valuations in the UK.
So does the pound go higher on this? People are kind of wondering how much sustainability there is in this sterling story.
I think potentially sterling is still well supported, which of course is a bit of a headwind again for the FTSE 100 because of the overseas earners. But yeah, generally I think the UK story is quite a positive one in a world where there's still quite a lot of instability.
So in terms of how I think about where I want to invest, is it, I've got weakness in Europe because of the China story and what is happening with luxury, and you can see that in the manufacturing story. I've got uncertainty in the United States. Does the overweight equity story work in an increasingly uncertain world?
Well, I think that we need to make a distinction here. I think that certainly Europe, the data has been softer. We're seeing a global manufacturing recovery, but Europe is underperforming on that front.
Oh, yeah.
When it comes to the US, yes, of course, the election creates a lot of uncertainty as we head into the autumn. But again, I think that growth is stable in the US. Inflation's moving in the right direction. We think the Fed can start to cut rates later this year.
So the rate cut story is the catalyst.
And I think that's important, yes. Again, of course, the election is hugely important, but I think, again, we also have to look at fundamentals, and fundamentals are still pretty strong in the United States.
So what do I need to see on the rate cut story to keep me on the front foot, to keep me risk on?
For equities, what's been priced in by bonds for this year is still absolutely fine. So 2 or 3 rate cuts is actually, I think, all that equities require.
Okay.
The challenge more is potentially for bond investors, because actually where we disagree with the curve is when we look into 2025, we have more rate cuts priced by the curve, by the Fed in 2025, and I think there the market might still be a bit complacent. We've seen bond investors attempt to price a sort of more aggressive Fed pivot a number of times. And generally we think that, again, we're in a different kind of regime, and for that reason, I think that, again, I favour equities over bonds at this point.
But in terms of how we invest in equities, is the S&P has outperformed the S&P equal weight by a massive margin. Do I pivot out of the S&P into the equal weight? Do I look for the more diversified indexes that give me a better diversification story? Is that where I want to be thinking about putting the money rather than more concentrated indexes? The S&P traditionally has been kind of not seen as one of those, but has increasingly become one of those.
Actually, for now, we're still, to the extent we're overweight equities, we're doing it via the S&P 500. We haven't started to buy the Russell 2000 yet. our stock pickers might be finding opportunities.
But even with the S&P, you don't have to buy the S&P. You can buy the S&P equal weight. You can buy the more balanced S&P portfolio because so many of the S&P stocks have not performed. But if the expectation is that they are going to perform, that we are going to see this broadening out, is that the way to go? You don't even need to go down into the Russell.
I mean, we've looked at the equal weighted again. We haven't acted on that yet because I think that actually there is still enough support. We still have a few more earnings to go with the tech sector. We'll see how those pan out over the next few weeks. But ultimately, I think that it's potentially too early to start underweighting those stocks.
Yeah.
And therefore, for me, I think it's still the S&P 500. And there's enough under the surface of the S&P 500 to support the market as long as those stocks are stable.
Okay. In terms of how I want to think about a portfolio, is it 60-40? Are we back to thinking about that? In terms of the kind of portfolio construction you're looking at right now, how different is it versus where we were even a few months ago? How am I thinking about the relative weightings that I've seen? You are obviously overweight equity, so that doesn't necessarily apply. But in terms of the way you're thinking about how the ratios work within the portfolio, what does it look like?
I think there are a number of things. I think, first of all, people have sort of been, after 2022, everyone's like 60-40 is dead. I think it's still a completely viable strategy. Equities for growth, fixed income for the old-fashioned reason, which is for yield, not for diversification.
And that's going to work, is it?
For yield.
Yeah.
And it means you need to recalibrate the yields at which you're willing to own fixed income. But I think that it still has a role to play. I think the big difference relative to the last decade is you also need to consider allocations to more inflation-beating assets. Things like commodity-related investments, for example, are more interesting than they were in the last decade when we were facing deflationary headwinds again and again. Now, I think it's much more about, if you're looking for diversification, you own commodities.
And in terms of that diversification, what is a reasonable rate of return now? What am I thinking? I can still get 4.5%, 5% on cash. How much am I going to beat my cash portfolio into that diversified portfolio?
Well, again, I think we're seeing, if you look at bonds are more challenging because of the inversion of the curve, but ultimately expecting rates to come down. And again, there's still enough return potential in equities to beat the cash rate. So I definitely would be advocating getting out of cash.
Okay. It's been great to see you. Thank you very much for stopping by to see us. Johanna Kirkland, Co-Head of Investments and Group Chief Investment Officer, joining us from Schroders. Equity markets this morning certainly under significant pressure. We are seeing that tech story being folded in. We are seeing the luxury story being folded in. We're also seeing the banking story being folded in as well. Deutsche Bank is under real pressure this morning. Its shares are down significantly. First quarterly loss in 4 years. It's also about the return of money to shareholders. It's the Postbank story. We need to delve deeper into what is happening with the banking story. We will do that next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
For this year, I think prudence would dictate that we step back from seeking a second repurchase authorization. We've already returned, 1.3 billion to 1.5 billion to investors so far this year, and so we think we're demonstrating an ability to stay on track.
The CFO of Deutsche Bank speaking there in conversation with Bloomberg's Ollie Crook. Deutsche Bank under significant pressure this morning. Let's delve into the details of what is happening, A, with Deutsche and B, with the wider banking sector. Bloomberg's Jenny Serrain joins us now on set. Nice to see you. Why is Deutsche Bank down as hard as it is?
I think, this is a quarter where they had this one-time loss. Even though folks kind of expected it, it even came in at the size that folks were expecting. They weren't expecting it to kind of impact the ultimate shareholder buybacks and kind of that capital return. And so a lot of times I think investors are willing to look past these little one-time items if it doesn't have that kind of farther-reaching impact. But when you heard, the CFO just there saying, I don't think we're going to go back and ask for another authorization, that's the kind of thing that gets folks worried that, longer term, is this going to weigh on their ability to kind of keep being a high-returning stock for us? So I think that's really what it came down to this morning.
And the market clearly taking that on board. BNP, equities, wow.
It was a surprising quarter for them, right?
Yeah.
I mean, I think it's sort of interesting because very rarely do you get the kind of satisfaction of talking about political volatility so much and then seeing it kind of show through in the results so immediately. But yeah, this was the first time that their equities traders outperformed their FICC traders. And I really do think that all boils down to the political volatility that we've been seeing.
So is that sustainable, I guess, is the question that investors probably are going to be asking?
Yes, I think that's why you see them not kind of having this outperformance today. Trading results often don't get the kind of credit where credit is due when it comes to shareholders. It isn't sustainable usually. You have these really lumpy quarters where things can look really good and then look really bad. You often hear banks talk about the year ago being super good, and that's why this time is super bad. And so you sort of get that kind of narrative around trading results. But for sure, I'm sure there's some stock traders over in Paris today that are feeling really good about themselves. So.
Well, they can enjoy the weekend of sport coming up with the Olympics. Santander's higher. You talk about the kind of the lumpiness. This is the kind of almost the exact opposite, you would have thought.
I think that's right. This is a bank that's really showing off the kind of strength of banking today. So when you think of banks, you think of taking deposits and making loans, and that's where they really outperform. So for as long as rates are still high around the world, that will still perform well. What I think you now hear investors asking is it sustainable as rates start to come down? And do they have the kind of non-interest income, those fee-based businesses that can kind of rev up in times where interest rate might start to fall? And so I think that will be the discussion over in Spain today.
But it's interesting that there's such big geographical diversity for that bank as well. Huge footprints in South America.
Yeah, absolutely. And so I think that's also where, you kind of see a very clear line on what the ECB is doing and everything here in Europe. Is it the same line in LATAM and Central America? And so I think that will be something that those guys have to.
So we've had UniCredit as well out this morning, got a whole range of banks. Pull it all together. What does it tell us about the European banking story in the second half?
It's really hard. I think today it's hard to kind of draw one straight line across because one area where we did see sort of cohesion was investment banking. So you really saw capital markets start to come back to life. You really saw advisory do well kind of across the space. And we saw that with the U.S. banks as well. So you had the similar story at Goldman Sachs, JP Morgan, Citigroup earlier this month. What I do think investors will start to ask is that sustainable? Just like what we talked about with trading, investment banking is often seen as lumpy. I do think that in general, we've been in a period of just really, a deal-making slump, very little capital markets activity at all. So on that front, there should be a little bit more, room to run, as it were. But is this sustainable? So will we see these kinds of increases in the third quarter, in the fourth quarter? Or was a lot of this activity just clients pulling forward what they would have done in the second half and sort of leaving the second half?
Because of the U.S.?
Yes, I think so.
Yeah.
I think the election story in the U.S. really has, a lot of clients looking and saying, okay, I was going to refinance in November. Maybe I should just go ahead and pull that forward. And that means that, while debt capital markets looked really solid in the second quarter, do they still hold up in the back half? I think that it still remains to be seen.
There's a lot of imponderables in the second half. Jenny, great stuff. Thank you very much indeed. Bloomberg's Jenny Serrano. What's happening with the European banking story this morning? Up next, we're going to take a look at some of the big movers. It's a busy morning. We need to show you some of these. You've got a lot of kind of mixed messages coming through from markets today more broadly. We'll deal with the details, the banking sector, the luxury sector, what's happening with the markets more broadly as well, with the tech story being folded in. We'll do that next. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Let's get you up to speed with what's happening with these markets this morning. There's a bunch of European movers that are really worth focusing on. Deutsche, we've already referenced, down pretty hard. We've discussed the reasons for that with Jenny Serrano. LVMH is under pressure, as you can see, down by over 5%. That's dragging on the luxury sector. That's dragging on the CAC 40. Carol Maggio is going to be joining us very shortly to walk us through that story. EasyJet is up today. However, I would just say, look at the 5-day charts on that. Basically, what we've done is fill the gap that we saw develop earlier on the week when Ryanair warned. So we're basically back to flat on the week, or maybe just a little softer than that. But that's what the EasyJet picture looks like as well. And Reckitt Benckiser out this morning talking about a strategy update, talking about spin-offs. The market seems to like what is happening there. Alphabet, Tesla pre-market. Quick look at what is happening there as well, just to show you what the numbers look like coming out of the States already this morning. A fairly negative picture, certainly for Tesla. And we are watching. These boards will update, I promise you, at some point. And the dollar is also up this morning. Risk off, plus also the poor European data. Anyway, we'll talk luxury in a moment. We'll get back to that story. This is Bloomberg.
names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, welcome back. You're watching The Pulse. I'm Guy Johnson in London, in for Francine Lacroix. Need to get you up to speed with the top stories. Let's do that right now. Tesla profits falling short again. Elon Musk calling for investor patience. Alphabet CEO also asking investors to wait a little longer for some results from their big AI investments. Deutsche Bank plunging after suffering its first quarterly loss in 4 years. It's booking a charge related to Postbank. BNP Paribas numbers look really strong. Equities have been really strong there. Equity trading. Santander lifting its revenue guidance. Plus, we need to talk about what's happening with the luxury space. LVMH under pressure. China's luxury slump hitting sales of expensive fashion and drinks. We're going to talk about that story in detail in just a moment. The big story in many ways, though, this morning is the economic data. There's lots of kind of equity stories that we need to focus on as well. But you see some really surprising PMI data out of Germany this morning on the manufacturing side that is super weak. And when I say super weak, I mean really, really weak data here. It was expected to pick up. That has basically cast a shadow over the whole of the European Union. And now we get the data out of the UK. So let's fold that into the story as well. So manufacturing out of the UK, better than anticipated. Haven't seen that across most of Europe this morning. We are seeing it, continuing to see it here in the UK. 51.8, that's up from 50.9. That was above expectations of 51. The services line comes in better than anticipated. No, better than the previous number of 52.4, 52.5. So we're in the margin, I would have thought, there on the services line. That takes the composite number here in the UK, which is really standing out versus the rest of Europe, 52.7. So the numbers in the UK are getting better. The numbers in the rest of the Europe, in the rest of Europe, in the Eurozone in particular, are getting worse, particularly led by the manufacturing story. Let's pull it all together. Let's try and get an understanding of what is happening here. Zoe Schneeweiss joins us now to give us a take on the picture. Zoe, I want to start with that German manufacturing number. Why so bad?
Yes, that German manufacturing number really is quite dreadful. That said, German manufacturing has been under that vital threshold of 50 for 2 years now. That obviously kicked off because German industry was so reliant on cheap energy from Russia, and as we know, that no longer is an option for Germany. Additionally, we do have the impact from China. Germany is an export powerhouse. A lot of those exports go to China. If China does badly, Germany will do badly as well. So part of this is just cyclical. The other issue is, though, that a lot of this is systemic. Germany very much focused on petrol cars. Now we've got the era of EVs. Germany obviously was late on that. generally Germany just needs to revamp its economy, and now for 2 years or 2.5 years has just failed to do so. And the prospects and then the ones outlined in these PMIs today don't make the situation look like it's going to get any better anytime soon.
Compare and contrast France and Germany for me.
Yeah, France has the advantage that it's not quite as reliant on manufacturing, it's more reliant on services, and France is just about to kick off the Olympics. So that's obviously a great thing for services. A lot of people are traveling there. You overall get this boost in the services sector, so that's good. France also, this time, for the first time now in months, the composite number was stronger than that for Germany, both of them in contraction, but France really edging toward that vital 50. That's, again, all down to services. Manufacturing in France still is bad, but they have the advantage here that they're just not as reliant as the German economy is.
Zoe, Lagarde talks at the last meeting of the September meeting being wide open. Does the German data make it even more wide open?
The data, the PMI data, and obviously Lagarde doesn't just look at Germany, although the ECB is based in Frankfurt, it looks at the Eurozone as a whole. The Eurozone as a whole just barely grew. It came in at 50.1. That's way lower than economists expected. Economists had expected 50.9. That would have been steady from June's number. So, but still, this drop in economic output, or slowdown in economic output, is something that typically would mean that those calling for a rate cut would get backing. However, we also have to look at the price inputs. The ECB does not have a growth mandate. It does, however, have an inflation mandate. And the numbers we get from the PMIs, from the private sector, are that input prices actually are increasing and output prices are hardly shrinking. So that does look like there's going to be a sustained pressure in inflation. And while that means probably a September cut is possible, let's see what happens after that. The ECB has warned that there's going to be a bumpy road on inflation, and they only predict that the level of 2%, that 2% goal, will be achieved in the fourth quarter of 2025, so quite a time away. But overall, the price numbers we get from the PMIs are not encouraging.
Zoe, certainly not. Thank you for the analysis of the data this morning. That German number, just absolutely horrible in terms of its indications for the wider Eurozone and what it's telling us about Germany and China and that relationship too. Zoe Schneeweiss joining us out of Frankfurt on the numbers. Let's talk about one of the other big stories that we're watching out of Europe so carefully this morning, and that is the impact we're seeing on LVMH after its numbers last night. Sales growth at the luxury powerhouse slowing last quarter. Wealthy shoppers, particularly in China, reining in spending on LVMH handbags. We've seen Christian Dior under pressure this morning as a result of that. Later today, investors are going to be looking at Kering for the latest on its brands, what's happening at Gucci. You've got the drinks business as well. You've got Pernod out, you've got Remy out this morning. I forget which one, out with numbers as well this morning. The other story I want to talk about as well is what's happening in Japan, which is an FX story. We've got lots to talk about. We've got the perfect person sitting next to me here in the studio to discuss all of it. Barclays Head of Luxury Goods Research, Carol Madger. Good morning.
Good morning. Thanks for having me.
Give me the top-down story on LVMH. What do you make of the numbers? What should I be taking away from it?
Yeah, so LVMH, it was a miss, of course, on both top line and the EBIT level. So on top line, I think all the key divisions, fashion leather goods, wine and spirits, watch and jewelry were a bit weaker than expected. And of course, the key division, FLG, so fashion leather goods, we have seen top line being at up 1% versus around 2% of the expectation. So just, a slight miss at the top line level. So here, by the nationalities trend, we have the Chinese being a bit weaker compared to the first quarter. So it was still positive, still growing, but at a slower pace compared to the first quarter. But on the other way around, we have seen the American cohort and the European as well getting a bit better here compared to Q1. So kind of a different, trends by the key nationalities. But of course, net was still, I guess, a bit weak. Same thing for the EBIT level. We have seen here as well a miss on FLG. So it was again still weaker. And I guess the key focus was also on the outlook. So how to think of H2, both top line wise and margin wise. And I feel like here on the call, there wasn't that much reassurance from the CFO around how to think about that for H2. So I think, there was a lot of still concern.
Is it the numbers
here
on the call that's giving you the greater level of concern?
I think it was really both. On the call, they talk about, I guess, to start with the top line level. There, of course, we have still like a low level of visibility on how to think about top line growth in H2. Yeah. So, of course, the Chinese are still quite weak on the sentiment level. So it's quite hard to, of course, gauge how the growth can look like. You will have for sure some easier comp base that could help to see stronger top line growth. But I guess, apart from that, it's quite hard to actually explain and, I guess, forecast the top line growth in H2. And then on the margin, there was, I think here as well, some, I guess, not strong commitment to see that the margin can actually be better in H2, and it can protect the margin in the full year. There was a lot of comment about the Japan market being now a bigger focus and actually having a negative impact on the margin.
Okay, talk me through the. Japan's seen a big currency devaluation. I'm told I can buy nice watches there for well below list prices that I can see elsewhere. Walk me through how that sort of mechanically works and how it translates into the margin story.
Yeah, so of course, right, that the Japanese market is quite attractive on the currency level for many tourists. Of course, the Chinese being the first one to go there. They buy much less domestically, and they all go to Japan because it's cheaper to buy luxury goods there. But the issue is that, of course, the OPEX level for Japan is less attractive because there is a much more variable cost base compared to a fixed cost base in some other markets, like Europe, for instance. So when you have stronger top-line growth, you actually also are having stronger OPEX growth. There is no here, improvement that you can see at the EBIT level because of that, because of the cost structure being much more variable. So basically, you don't have that much boost at the EBIT, despite the boost at the top-line level. That's the issue we are seeing right now with Japan. So it's less attractive, despite what you could all think.
What I'm surprised about is their surprise this morning. Like many of these trends that we've been talking about have been present for the last few quarters. Is it just a continuation? It's not getting better. Is that what the problem is this morning, or is the situation getting more difficult?
That's a good question, which I think, again, is still, I guess, quite hard to figure out at the moment. But yeah, I think the issue of today is the lack of visibility and the lack of reassurance, about H2. Okay. I think we all expected that Q2 was going to be weak. That was, in a way, quite well known. But we all hope that H2 could get stronger on the back of, again, easy comp base and maybe some better trends on the Chinese, the American, etc. But I feel like right now we are not seeing that as of yet. And again, the margin story here at LVMH was also, I think, an incremental maybe negativity to the story.
If LVMH is struggling, tell me about the rest of the sector.
Yeah, of course, it's a bad read across for the rest of the sector. LVMH being the key anchor name in the space. So, of course, we have seen so far names like Swatch, Burberry already reporting some quite weak numbers. Definitely some miss on the EBIT level for both, or on the outlook. Richemont also reported it was okay, but of course we still have tonight, Moncler, Kering reporting. So, of course, some quite, I guess, bad read across on the sentiment of the key luxury goods consumer, Chinese especially. And then we also have, Hermès tomorrow. So I guess, it's quite bringing a bit more caution now on what to expect for the sector.
Okay, let's pull it apart a little bit. Kering, Gucci, when does the turnaround come? What are you expecting from Kering?
Yeah, so here we're still quite cautious on Kering. Of course, they are doing this phase of transition at their core brand, Gucci, which I think is still in a way at the beginning of the stage of the transformation. So I feel like Q2 could still be very weak in terms of top line growth. We expect the brand Gucci to be down like pretty much close to 20% negative in Q2. And then they should likely have, a bit more of the product of the new designer in the store from Q3 onwards. So we could hopefully see some improvements in the second half of the year. But I feel like right now in the first half, so Q2, trends could still be quite weak on both top line and the margin, of course.
Anything with a long list, I would assume, would be protected from this. Is Hermès protected from some of the trends we're seeing at the moment because of the long wait list they've got?
I think it is, yes, better protected. Of course, those brands are a bit more exposed to the more, let's say, wealthy consumer cohort, who, of course, I think less impacted by all these macro headwinds we are seeing today. So, yeah, I feel like names like Hermès, could likely do better in terms of the performance at the top line and the margin level. We also have said Richemont was also quite resilient in a way with their more, I guess, higher pricing points exposure.
Let me just throw you a slightly curveball question, which I'm sure you'd be delighted about. French politics. Is there an issue with coming out of the French political story into the big French luxury names?
I think right now it's quite limited impact. I guess the key issue is mostly, uncertainty. You just, of course, don't know what's going to happen exactly. And so, of course, when you don't have visibility...
taxes and all that kind of stuff, do you think that... We think about luxury being French, but actually it's a global market.
Of course, yes.
Does it matter what happens actually in France for these stocks?
I guess to a small extent, yes. Of course, France is a key touristic destination, so I guess you could see maybe less tourists go there if the country becomes much less attractive for, several reasons. So that could be a point. But of course, I think broadly speaking, France is likely below in terms of, weight of sales, 10% across all the sector. So I guess the impact on numbers could likely be limited. I think it's mostly uncertainty and maybe the level of attractivity of tourists that is the key issue here.
So do I want to own luxury stocks right now? I know it's a case-by-case basis, single stock to single stock, but broadly, is this a basket that is do I want to have it in my portfolio?
Yeah, it is definitely, I think, a case-by-case story here. But I guess the space usually tends to work when you have, EPS upgrade cycle and, of course, top-line growth momentum, which I guess we really are not seeing that much right now. I think we still maybe are at the risk of seeing more downgrades in the sector compared to seeing upgrades on earnings.
And that's not priced yet.
I think in a way we can maybe still see, again, some negative surprise here. Again, back to LVMH, we were all expecting that, the negativity was going to be finished by H1 and then see better trends in H2. But I feel like now the door is still open for maybe some further downgrades in the second half. So I guess, maybe it's not fully priced in.
That call sounded very interesting last night.
Indeed.
Carol, nice to see you. Thanks very much.
Thank you.
Stopping by to see us. Barclays Head of Luxury Goods Research, Carol Maggio, joining us on what we got from LVMH. As she says, caring's out. We've got Hermès numbers out tomorrow morning as well. We'll keep an eye on all of this to watch out for as this space develops. We need to probably return back to what is happening with the political story over in the United States. Kamala Harris launching her campaign in the swing state of Wisconsin. We'll have more on how she plans to take on Donald Trump. The polling's starting to get really interesting. We'll dig into that as well. That's next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So, the U.S. Vice President Kamala Harris has launched her presidential campaign with a rally in the swing state of Wisconsin. Harris touting her economic agenda and attacking her opponent, Donald Trump, referencing her past work as a public prosecutor.
In those roles, I took on perpetrators of all kinds. Predators who abused women, fraudsters who ripped off consumers, cheaters who broke the rules for their own gain. So hear me when I say, I know Donald Trump's type.
Harris in Wisconsin. Let's get more on what we learned and what we're going to get going forward. Bloomberg's Vonnie Quinn joins us now from Washington. Vonnie, what do we take away from that first campaign speech that she delivered in Wisconsin?
Well, you see those lines that are going to be appearing in the stump speech, I think, Guy, right? The campaign staff will be testing out some of these to see how well they go down. And obviously that cheaters, fraudsters, predators line is going to stay there. She's also testing out some of her ideas. Bear in mind, she has only ever done rallies like this as a vice presidential candidate before, never as a presidential candidate. So she needs to get her feet wet, get some experience doing this and, you know, get the backing of those segments of the electorate that perhaps haven't really gone to rallies before and maybe draw out some more. She has 3.5 months. It's not nothing. It's maybe a shorter cycle than most, but she is testing out some of these ideas. At the moment, we know all of the ideas about building up the middle class, about, you know, adding childcare, family leave, raising the minimum wage. We've heard some of these. We'll know more about her foreign agenda and so on as she starts to look for advisors and as she starts building up more of a staff in the next several weeks. To that point, she continues to campaign. Tomorrow she'll be traveling to Indiana and Texas. And then tomorrow, I say, it's actually Wednesday, it is today, your time, President Biden will actually be returning to the White House and addressing the nation, which is kind of crucial because we haven't heard from him except for that phone call into the Kamala Harris campaign headquarters since last week, since he went into quarantine with COVID-19.
Yeah, so much over the next few hours coming up. The other factor we need to fold into the mix as well is the fact that the Israeli Prime Minister Benjamin Netanyahu is in town as well. He steps into a really difficult situation. We've now got Harris and Trump. He's going to find that, I suspect, difficult to manage. How will they respond to him? How will Harris and Trump respond to Netanyahu, do you think?
It's funny, Guy, because we don't fully know how the former president, Trump, will actually respond to him, except that he has posted on X that he is meeting him in Mar-a-Lago on Friday. And, you know, you would love to be a fly on the wall for that meeting, right? Because they were huge allies during Trump's first presidency. But Trump was extraordinarily angry with him for congratulating Biden on winning in 2020. And he's also, in recent times, basically sent the message that Netanyahu should finish up this war. You mentioned that he's in town. There is extra security and extra police presence in Washington, D.C. at the moment. Protests ongoing in and around Capitol Hill because Netanyahu does address a joint session of Congress Wednesday. And then he's going to meet Biden on Thursday and meet Harris at a certain point separately from Biden and then meet Trump. So Netanyahu will be trying to feel out the different positions of the various leaders. Biden, for his part, we know, wants a permanent ceasefire, perhaps preceded by a temporary ceasefire. But every time he says that's imminent, it hasn't come to fruition.
Thanks, Vonnie. Vonnie Quinn updating us on the latest on U.S. politics out of Washington, D.C. Let's talk more about what is happening in the United States. The U.S. Secret Service Director Kimberly Chittle has resigned after taking responsibility for the security failures at the rally where Donald Trump was shot. The Deputy Director, Ron Rowe, will lead the Secret Service as acting director going forward. Both Republican and Democratic lawmakers called on Chittle to step down. The French President, Emmanuel Macron, says he won't pick a new prime minister before the end of the Olympics and doubled down on his call for a political truce following weeks of turmoil in France. Meanwhile, Politico is reporting that France's far right has signalled it's ready to support the far left to repeal Macron's pension reform. And Ukraine's foreign minister has arrived in China to discuss Beijing's possible role in ending Russia's invasion, the first visit to China by a senior Ukrainian official in 8 years. Beijing has put forward proposals for a peace initiative that would include Russia at the table. What we're going to do next, it has been a huge morning for European bank reporting. Deutsche Bank, BNP Paribas, Santander reporting. We're going to hear from their CFOs and get the latest on how the markets have been reacting to the results. That's next. This is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Yes, we have very solid results. We basically have that on the back, amongst others, of all the cross-selling that we do. I am cautiously optimistic of what you see in the Eurozone. Yeah? Inflation is tapering off. Therefore, the ECB is also reducing the interest rate. So the economy is picking up. And that's basically fueling a positive spiral.
The second quarter was absolutely a continuation of the first. So momentum in the businesses, on the revenue side, also just client engagement, market share growth. For this year, I think prudence would dictate that we step back from seeking a second repurchase authorization.
I think we are building a very strong momentum at Santander through a combination of a very positive evolution of our 5 global businesses. What explains our strong momentum today, again, is the combination of more customers and simplification, digitalization, automation, keeping costs flat.
CFO Central, the CFOs of BNP Paribas, Deutsche Bank and Santander speaking to Bloomberg this morning. Let's talk about the various share price reactions we've seen for those stocks. As you can see, Deutsche under significant pressure after its numbers. Paribas is interesting. It's soft as well, despite an absolutely awesome performance by its equities team. Santander is up. Traditional banking delivering the efficiency that has been driven through that business really beginning to drop down. UniCredit down by 1.7%. So that's what the banking story looks like. Euro-dollar looks like this on the back of the dismal data we've seen, particularly out of Germany on the manufacturing side this morning. And let me just wrap things through into what we're going to see in the United States a little bit later on. Tesla and Alphabet out with numbers last night. Both stocks are down. Tesla pre-market down by 7%. The fair value on the S&P this morning down by circa 0.5%. The brief is next. Danny Berger, Manus Cranny in New York. This is Bloomberg.
Biggest risk in property and casualty is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set the agenda.
Failure to impress cost big tech. Tesla points another disappointing quarter from deliveries to delays on robo-taxis. Alphabet adds fuel to the equity sell-off. AI underwhelms and overshadows a revenue beat. And VP Harris attacks Republican nominee Trump in her first campaign rally. Trump says that he is willing to take on Harris in a debate. Good morning, Manus.
Danny, good morning. Underwhelm at your peril. Quite literally, the slaughterhouse is open. If you underdeliver, there will be a chop against your stock. Think UPS right the way through to Tesla, down 7% and change this morning. This is where we are, 6.83%. It has been a little bit more virulent than that. So the bears are getting everything that they wanted, if not so much that it's a terrible result. It's just there are delays, underwhelming margins in Tesla. We'll talk more about that in just a moment. NVIDIA, Elon says he's doubling down on his Dojo supercomputer. Again, taking another little bit of a chunk out of NVIDIA. You don't need many reasons to take some heat out of this market. The Mag 7 trails the Russell by 5% over the past 2 weeks. We're going to catch up with Julian Emmanuel. He says the correction has already begun in time and price. But what is going on in the bond markets? You've got this pressure on the tech side moving into the Russell. Is that a real manifestation? What's happening in the bond market? Well, you had the Richmond Fed, the lowest since 2020. Existing home sales down 5%. And the 2-year auction went pretty fine yesterday. You've got fives coming down the pike today in 70 billion. So again, the cracks and the fissures in the economy are becoming more apparent. Dollar yen. I like putting dollar yen on the board because it's strengthening for the third day. You've added almost nearly 2% to yen strength. Is this a manifestation of the carry trade being unwound rather than a deep-seated fear of what happens next from the Bank of Japan? Danny, good morning. There's lots of guts and gore, isn't it, this morning?
So violent this morning, Manus. Geez, I guess for a bear, it is a violent morning for you. I know Tesla's falling more pre-market, but I think Alphabet's miss is more telling because things like advertising, all of that did fine. It was their AI search feature which didn't show up, and that's going to be the problem for big tech because they've been spending so much money. If they can't show up with AI results, the market clearly is punishing that and just adding to this rotation we've been getting.
But I think this is where, I mean, we both said it, the bar, where is the bar to profitability in Mag 7? It's not that the profits are collapsing, it's just that the expectations, the estimates are so high. And it goes back to what Amy Wu Silverman said to us yesterday, glasses on, glasses off. It's one of those days. This is what, you know, this is what happens when you get older. The pivot, the last earnings season, the pivot was for FOMO and MOMO. In other words, we're bidding up the calls like Billio, and here we are. The manifestation is coming true. It's the fear and loathing of the downside.
Well, Goldman already before this earnings season said big tech is spending too much. They are spending too much in AI, and they themselves said it's not so clear that that's going to show up in the results. And again, Alphabet lays out that it doesn't show up, at least for now. But how patient are investors willing to be when we've been hitting record after record in this equity market?
This is going to take delivery from imagination on AI to actual revenue generation. So we started the day with stocks. There's an interesting one, but never too far from politics. Look, the Vice President, Kamala Harris, officially launched her bid for the White House in the swing state of Wisconsin. Harris attacked Republican nominee Trump, referencing her past work as a public prosecutor.
In those roles, I took on perpetrators of all kinds. Predators who abused women, fraudsters who ripped off consumers, cheaters who broke the rules for their own gain. So hear me when I say, I know Donald Trump's type.
So she's full in on prosecutor versus felon. Meantime, Donald Trump's campaign, they filed a complaint with a federal agency claiming the transfer of Biden's $96 million campaign war chest to Harris violates the law. Trump's lawyer referred to the move as a brazen money grab and the biggest violation in the history of Federal Election Campaign Act. Vonnie Quinn is with us in Washington. Vonnie, so this is the Trump response. It's about the money. But if we stand back and we look at her first appearance, this is the first appearance on the campaign trail. She really is laying out her desire to go hard and heavy on the character of the former president.
Absolutely, Manus, and testing out those lines that are working right now. We're going to hear that line over and over again about the predator, cheater, fraudster. It goes down really, really well because it's funny. It shows her human side, but it also, as you say, points to her prosecutorial side and the fact that she is not afraid to prosecute, you know, even on the campaign trail, and reminding people as well that Donald Trump is a felon and has been impeached twice. You can tell that the Trump campaign and Donald Trump himself are bristling because we had many developments today, not just that complaint that was filed with the FEC, but also Donald Trump holding a call with reporters, which is something he never does. He held a call with reporters, took questions and said he'd be quite happy to debate Kamala Harris. He would actually be fine with debating her several times between now and the election date. That complaint, by the way, it's a little bit spurious. It's been filed. We'll see what the response will be. But that $96 million was raised for the ticket. And technically, Kamala Harris can use it without any problems. And, you know, I mean, she's raised so much money and has got so many donations, from big to tiny money donations so far, that even if she couldn't access that money, I'm not sure it would be that much of a problem.
Well, Harris goes to Wisconsin. We see Prime Minister of Israel, Netanyahu, coming to Washington. Usually that would take up all of the political oxygen. Vonnie, this time it is not. It is overshadowed by the race. We know that Harris isn't meeting with Netanyahu while Trump is. What do we make of the differences there?
Well, so Harris is actually going to Indiana and Texas on Wednesday to campaign. If there is a spot where she can meet Netanyahu, I believe they are going to try and make it happen. We do know that Netanyahu is giving a joint address to Congress, and there is a heightened police security in Washington, D.C. because of that. Lots of protests ongoing around Capitol Hill. Then on Thursday, he does meet President Biden, who will be back at the White House. He is addressing the nation tomorrow night, Wednesday night at 8 p.m. Eastern, the first time we'll have seen him properly since he went into isolation for COVID-19. And then Netanyahu goes to Mar-a-Lago Friday to meet Donald Trump. This is what Trump posted on X in the Tuesday day. And it's important because we don't really know how President Trump, if he were to be re-elected, would handle the Israel war on Hamas. We know that they were great allies, Netanyahu and Trump, when Trump was president originally, but that Trump was furious with Netanyahu for congratulating Biden when he won in 2020, and that he has also, told Bibi to finish up this war. Biden, for his part, wants that ceasefire. We'll see if he gets it. Every time he says it's imminent, it hasn't come to fruition.
Yeah, Biden has really said he's concentrating the rest of his presidency on that foreign policy. Vani, thank you so much. Bloomberg's Vani Quinn waking up early for us, or staying up very late, rather, in Washington, D.C. Joining us now is Lindsay Newman, head of global macro geopolitics at Eurasia Group. Lindsay, you write that for the U.S. political system, this level of uncertainty is unprecedented. Just given over the past few days of what we've heard from Harris, either be it her decisions on foreign policy with Netanyahu, not meeting with him, her speeches, do you have any more certainty on what a potential Harris presidency might look like?
This has been really a storybook start for Vice President Harris. She could not have written up better. If we think about just a couple of days ago, it was great uncertainty about whether she would even face any other competitors in the replacement for President Biden. And here she is. She's now secured all the pledged delegates that she needs to begin the nomination process. We expect that to begin virtually next week. As Bonnie was just laying out, she has brought the news of her selection has brought historic rates of money in through the door over in the last 48 hours. Her messaging, it appears to be popular. The prosecutor versus the perp, the fight for the future, but also irreverent. There is a belief, really, that she could potentially expand the Democratic coalition, expand the umbrella of voters in a way that Biden it was not perceived that he was going to be able to deliver an expanded umbrella of voters for November. So Democrats really have momentum here. And the question of what kind of president she would be, what would her policy be, it is, in a sense, a black box, particularly around foreign policy issues. We have to think this would be mostly a policy continuity story, including around Europe relationship, transatlantic relationship, NATO, the U.S. approach to Ukraine. But all very importantly, there is this perceived bit of daylight on Israel, on Israel in terms of Biden versus Harris's policy on Israel or approach to Israel. And we know this is overhanging with Prime Minister Netanyahu's visit this week.
Lindsay, good morning. Yeah, I mean, Kamala Harris made 17 trips abroad as vice president. None of those were to Israel. Tell me this, there's a great phrase in British politics, what cuts through? Kamala Harris is going to spend a lot of time in the swing states. We know that. The halo effect will dissipate, and that's what we've been saying for a couple of days in terms of the shine, the money rolling in, etc. So when we stand back, what is she going to focus on in those swing states to take her over the line?
President Biden had difficulty navigating this dynamic between the centrist part of the party and the progressive part of the party. Kamala Harris has stepped in and seemingly has animated the base in such a way that she's bringing in additional demographics, additional components. The progressives are animated by her. AOC has thrown her support by her. So she can sort of, in a sense, sidestep this tension that Biden just could not break free from. And if she's able to do that, that is what will break through. So I completely agree with you. As you say right now, the polling is essentially at a statistical tie between between Trump and Harris. There's this poll overnight that has actually put her ahead of Trump, but that will fade, and we're still in that honeymoon phase of understanding what is going to be her messaging. So far, perpetrator versus the prosecutor, the fight for the future, a lot of the same policy as Biden has, and then it really is a bit of a ball in Trump's court. How does he react to this new replacement candidate? He doubled down last week at the convention with the J.D. Vance pick on animating his base. That's what he put all his chips in the table for. How does he respond? And so far what we're seeing is he's trying to drive an election integrity story. He's trying to drive a story about how everybody knew that Biden wasn't fit to serve, including Harris. We have this news overnight of the FEC lawsuit. So that's what we need to be watching for.
And to that point, Lindsay, there's a story in Politico that essentially senior Republican leaders have gathered around and said, stop campaigning on things like race. Stop campaigning on things based on gender. That was after some Republican representatives, Tim Kirchhoff of Tennessee being one of them, calling her the DEI candidate, basically saying that she doesn't deserve it. And Republicans, again, the leadership said, stop doing that. It's a losing argument. What does that show us about the weakness of a Republican ticket where it is Trump and J.D. Vance in battling someone like Vice President Kamala Harris?
Yeah, Jenny, we'll never know if Trump, given the benefit of a couple extra days, would have still picked J.D. Vance. It felt like J.D. Vance was his pick. But it does mean, as I said, he's doubled down on what his messaging is, what he's been standing for since he left office, the rigged system, the idea that people are being left out and that it's the Democrats who are actually the threat to democracy. And it's really puts him in a difficult position now to have to pivot and actually potentially have to expand his umbrella in a way that, say, a Nikki Haley VP pick may have enabled him. And that's what he's going to be struggling with over the next couple of weeks and months. And we'll see. That will be, in the postmortem, a very impactful ability for him to actually do that, whether he's able to win in November. We still think that he has the base case scenario that he will win, but the race is tightening.
It is, and then it's going to come down to who she chooses as her vice president pick. And that is going to be the interesting running mate when it comes, and it is coming down to some of those swing state names. Lindsay, thank you so much for joining Danny and I this morning. Lindsay Newman over at Eurasia Group. Other stories trending on your Bloomberg terminal this Wednesday morning. Deutsche Bank shares are plunging this morning, seeing its first quarterly loss in 4 years amid a trading slowdown. The bank booked a charge tied to a legacy issue at its post-bank retail unit. The bank said it will most likely refrain from a second share buyback this year.
Elsewhere in European bank earnings, BNP Paribas, for the first time ever, had equity traders that made more money than their fixed income colleagues. Revenues from that unit jumped 57% in the period, more than making up for the slight decline in bond trading. Even despite that, shares in the French bank are down this morning because of pressure on its retail banking activity.
Elon Musk confirmed Tuesday that he was making some donations to his super PAC supporting Donald Trump's campaign. He acknowledged making donations at a much lower level than the $45 million a month pledge mentioned in previous reports.
Well, coming up, big tech weighs on futures this morning. We're going to take a look at both Tesla and Alphabet's results next on your Bloomberg Brief.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
wanted to make some important changes that I think would improve the sort of the robo-taxi, the main thing that we're going to show, and we're also going to show off a couple of other things.
Well, Tesla shares are slumping, as you can see there. The automaker reporting its fourth straight quarter of disappointing profit. Investors now have to wait until October for the debut of the much-waited-for robo-taxi prototype. Craig Trudell is with us this morning. Craig, I don't know where to look across this series of reports. Slippage on timing, slippage on deliveries, slippage on margins. I mean, it was a fairly disappointing narrative given the run higher on the stock. We just didn't get delivery.
Yeah, I think pretty much across the board, the numbers were disappointing. I guess on the revenue side, there was, there was a beat there, but some questions about the sort of staying power of that, because a good portion of that bump had to do with regulatory credits. So selling, credits to other car makers struggling to meet emissions requirements, which may actually be weakened if Trump returns to the White House. That is, one aspect of Trump's policies that didn't get touched on. There were other elements that were covered on the call, from subsidies to whether or not Tesla ought to be investing in Mexico. And it was pretty remarkable that, for a CEO who has so publicly come out, getting behind, former President Donald Trump, having to kind of answer for the idea that there are a few ways in which him returning to the White House would potentially hurt Tesla.
Well, there's this irony that in Craig, and also, having an Elon Musk who went to China to try to get wins from the Chinese government, and having a Trump administration, or let's be honest, any administration, be very tough on China. Is there some element of having an Elon Musk that is donating to a Trump campaign, that is speaking to him frequently, that there's this belief that they can somehow be exempt from potential new policies from a Trump presidency?
I think you've seen some analysts ponder whether or not this may have something to do with the fact that Musk is under a lot of regulatory scrutiny. So the Justice Department and SEC have looked into the company's claims about self-driving technology. That's really what Musk has sort of tethered this company's future to. And the fact that they've been selling consumers for years on this idea that eventually their car will be able to, become a robo-taxi at sort of the press of a button or a software update. If the feds were to come after Tesla over not having delivered on that, it would really do a number on this company, given how all in Musk is now on AI and self-driving.
Yep, you feel it. Shares down 7% this morning. Craig, thank you so much. Great to see you. Bloomberg's Craig Trudell. Now, another stock we are watching after it reported earnings is Alphabet after the bell. It did beat on revenue expectations, but the stock down 3% in the pre-market trade. Wall Street clearly not impressed by the lack of results from AI investments. For more, let's get over to Bloomberg's Shauna Ghosh. Shauna, this is the thing that everybody is concentrating on big tech because so much money has been plowed into AI. How soon and how willing are investors to wait for it to show up in the results?
Not very long, clearly, judging by the falling stock pre-market this morning. As you say, we know that the chips required to power these new artificial intelligence services are extremely expensive. Every time you make an AI search on Google or a competitor like ChatGPT, it costs those companies money. That the money is fractional, but if you think about millions, even billions of people doing that, that's a significant expenditure. And yet we're not necessarily seeing the direct revenue translation for these companies. Google at its core remains an ad company. It has tried to do many other things, but predominantly where it makes its money is still advertising. So understandably, investors are trusting in that and want to see a clearer translation between AI expenditure and what we see on the ad revenue side. Now, Google actually did well on sales, but the question is whether it would have done well on sales anyway without some of the new AI features. Actually, Google did roll out some new AI features in May. They didn't do particularly well. You know, people may have read about Google's new AI and such, suggesting that people put glue on pizza to make the cheese stick on correctly, and that had been drawn from a joke post on Reddit. So clearly some issues there. So you know, I think TBC, we've still got a little while to go before we see AI translating directly into that ad revenue.
Growing pains of AI. I just eat the pizza way too much of it. I mean, you're right, 48.
You need glue on pizza, man? I'm worried.
No, I just eat way too much pepperoni pizza. Charlotte, thank you very much. 48.5 billion in advertising. But of course, as you said, Danny, it is about the capex. That is the issue for these companies. They're spending so much on advertising. So much on investing in R&D. Coming up, we take a look at what else makes your headlines around the world. A little bit of luxury for you. LVMH, not exactly going to plan in China.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Front page news, short and sweet. Louis Vuitton has not had the pleasure of Danny Berger enough. I'm being facetious. Stocks at a 6-month low. Organic revenue in fashion and leather way below what they estimated. And China is under pressure. Danny, the sales tanked by 14% there.
The silver lining for them is everybody is going to Japan and buying goods. Their Japanese sales really strong to the point where they said that they're not going to raise prices in Japan because they're worried about the currency fluctuation. So I guess go to Japan is the moral of the story. Buy some LVMH there.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Failure to impress cost big tech. Tesla posts another disappointing quarter from deliveries to delays on robo-taxis. Alphabet adds fuel to the sell-off as AI underwhelms and overshadows a revenue beat. And VP Harris attacks Republican nominee Trump in her first rally since the launch of her campaign. Trump says he's willing to take on Harris in a debate. Danny, good morning. Underwhelm at your peril.
Underwhelm, and it makes the rotation live another day. But this time, the flavor is different. It is not small caps catching up. It is big tech's disappointment. You lay them both out there, Manus. It is Tesla, and it is Alphabet. The issue this time means that the S&P 500 future is down about 0.8%. We've already fallen 4 out of the past 5 days. That is something that this market, the S&P 500, hasn't done since April. So is there a sentiment shift? Russell 2000 futures, they outperformed. They're still down, but doing better. Down about 1/3%. Barclays says buy on the tech weakness. That still fundamentally there's a good story to tech. So you want to buy on any of these earnings weakness. So they would be buying this dip. Meanwhile, U.S. 2-year yields, they dipped further this morning, about 5.5 basis points, fell about 2.5 basis points yesterday after some kind of tier 2 data, that is housing data. The Richmond Fed's manufacturing index, both of those were weaker. And a 2-year auction that went off without a hitch. Your 2-year yield this morning, Manus, at 4.43%.
Yeah, how hungry are they going to be for the fives that come down the pike today, Danny? And as you say, it is about taking a chunk out of big tech. Don't forget, of course, we saw part of this last week, and then on Monday you saw this Monty of dip buying, didn't we? Like, Nvidia was down 9% last week. We saw a lovely rally on Monday. People said, okay, this offers us value. But here we are. It's not that Alphabet delivered such a paucity of results. They just didn't overwhelm to the extent that the market had been anticipating.
Right, because so many people have said that for the rotation to continue, you're going to need to see a change in fundamentals, not just sentiment. So is this the change in fundamentals that goes alongside sentiment? Because you and I talked for so long, you know, that Pavlovian urge to keep buying the dip, that every single time that big tech sold off, you'd buy the dip. Barclays says to do it. But if there is a change in story, that the AI monetization isn't showing up, are you really willing to buy the dip this time?
And that's where there was a little bit of a wobble in the capex numbers within Alphabet. And it's not just Alphabet, but there's a capex within all of the Mag 7 in terms of the capex to monetization ratio. Mag 7 underperforms the Russell by 5% over the past 2 weeks, and yet the money flows into your favorite thing, Russell 2000, and Julian Emmanuel's favorite topic. But we'll get to that in a moment.
I'm really excited. Stick around for that conversation as well. Julian Emmanuel from Evercore.
So let's just drill into the Tesla numbers there. They're getting smacked pre-market, along with pretty much the rest of tech after reporting yet another disappointing quarter.
I wanted to make some important changes that I think would improve the vehicle, the sort of the robo-taxi, the main thing that we're going to show, and we're also going to show off a couple of other things.
Let's get to RBC's Tom Narayan. He has an outperform rating on the stock at $227 a share. Good to have you with us, Tom. So I don't know where to start here. If it wasn't for the regulatory credits at $890 million, the rest of it looks pretty darned awful reading to me. Margins poor, deliveries light, slippage on new models. Find for me a gem in here, or whether I should be looking at a continuation of the sell-off that I'm seeing this morning.
Yeah, I think you have to look at this stock in perspective, right? This is up, the stock's up 20% in less than a month on a delivery number, to your point, that was down year over year. Clearly, I guess the bright spot would be that sentiment is on their side. People want to be owners of this stock. But as you pointed out, a lot of what happened here was discounting. Because if you take the regulatory credits out, the margins, automotive gross margins, ex credits was 14.6%. Consensus was expecting like a 16%. So a lot of discounting led that delivery number. But I do think people want to own the name. The robotaxi comments I thought were kind of high level in nature. But you're seeing folks take a closer look at it. There is some anticipation now on this October event. So I do think in a positive sign that robotaxi narrative that was previously looked at as kind of a science fiction project. Now I do think people are giving it more credibility. That could be a positive, but still, this is very high level nature.
Yeah, Tom, and I know you've pinned a lot of what you see in your estimation as Tesla's growth on that robotaxi narrative, and I know you've made some estimate changes there earlier in the year, but Elon Musk on the call said, if you believe Tesla will solve autonomy, you should buy Tesla stock. And all other questions are noise. Again, Tom, I know the robo-taxis are important for their growth, but are you concerned that Musk is just brushing off the rest of their business as, in his words, noise?
Yeah, I tend to agree with what you're getting to. I mean, it is an autonomy stock. The actual car business is less than 10% of my valuation, but you need the cars to get FSD on them to sell autonomy, So you want to have as many Teslas on the road to push FSD, and then later on this translates to robotaxi as regulators and consumers get trust in the technology. So I think he's right that autonomy is the future and it's the lion's share of the value, but you need the cars on the road in order to sell FSD and sell autonomy.
What is the timeline, Tom? I mean, there are many, many issues within Tesla. Slippage on every promise is pretty much high on the agenda. What is the distance between the delivery of a product like robotaxi, but more so the acceptance of it by us, by Danny picking up one, by me getting into a fully self-driving one and trusting it? Is that a short conversion, Damascene-like conversion moment for us in the world, or is it a long lead time and therefore we need to be a lot more patient?
I think it's the latter. It is a long lead time. It's not only the tech needs to be right, it's also the regulatory. You heard GM earlier yesterday, Mary Barra, CEO, comment about how difficult it has been with their purpose-built vehicle and actually abandoning that because they weren't able to get legislators to change a law to allow a car without steering wheels. It's a tough journey. It'll take a long time. But the thing to highlight here is it is going to happen. And when it happens, it'll be one of the most transformative things to happen in society. And I think when it does happen, all of us will be in these cars. In 50 years, we'll be looking back and be surprised that we used to drive these weaponized objects all around the highways. So it is going to happen, but it's not going to happen anytime soon.
Tom, I mean, that's the regulatory story in the future. I want to talk about regulatory in, let's say, a couple months' time, in November, when we know who's going to be the next president of the United States. For Tesla, we've been talking about it here, how their margins were okay because of regulatory credits. And that $7,500 credit from the IRA to buy an EV is a huge part and a driver in demand, which is otherwise weak. What happens to Tesla if it's a Trump presidency?
Yeah, and we heard his commentary, Elon's commentary yesterday on the call saying that the IRA were to be removed, it would actually be a net positive for Tesla. I don't know if I agree with that. Maybe longer term in a weird way where other OEMs are taken out. It's a net negative, near term especially. Tesla produces a lot of batteries, and it's going to produce a lot more in the U.S., gets IRA credits there. Pricing is the #1 obstacle for EV penetration, especially in the U.S. Those credits help get those cars out there. So yeah, if there were obstacles on the IRA, it would definitely be a negative for Tesla. That said, I do have to say, it's difficult to remove the IRA. First of all, a lot of these battery facilities are responsible for a lot of jobs, and they're in states like, Ohio, Tennessee, Michigan, red statey, battleground state areas. A lot of this that you hear is a lot of bluster. If you remember in 2018, 2019, then President Trump talked about tariffs on Canada for aluminum and everything. And then a lot of these tariffs never actually happened. So a lot of these just may be political threats. At this point, the EV train is definitely going to happen. And the IRA is very difficult to just undo. It is law, and it's really hard to undo that.
I know we're going to get Ford's numbers yesterday. Mary Barra obviously has cut her dependence or her belief in EV. Set the table for Ford. Profits did well yesterday for Mary Barra. The stock did nicely. On Ford, where do they lean? How do they deliver?
Yeah, and I think for Ford, unfortunately, the quarter itself could be a challenge. I think estimates are a little bit high on their EBIT margin guidance, but what everyone's really focused is on the guidance for 2024. With GM, they had some problems with China, and I think that's why the stock sold off despite a beat and raise. Ford doesn't really have China exposure, so that's a positive. And the guidance suggests a big downshift in H2, so there could be something good if they raise. But it all comes down to their EV business, which is losing a lot of money. EVs were flattish quarter to quarter, so I don't anticipate anything amazing happening there. So we tend to be on the sidelines, I think, on this one, especially after you saw this sell-off hard of GM, now Tesla. Autos seems to be an unfavorable place to be. Pricing is coming down. It's a deflationary situation. That's not good for any of these guys.
Okay. Tom, thank you very much. RBC's Tom Narayan, really great to see you, and we'll keep track of that. Manis, a new column from Bill Dudley just out on Bloomberg now.
Yeah, when the facts change, and this is basically what he said, when the facts change, so I've changed my mind. Of course, you're talking about when the Fed should cut. I've changed my mind. The Fed needs to cut rates now and not wait until September. So this is a punchy shift.
Yes. Yes, Bill Dudley is someone who has argued for higher for longer. He goes through the reasonings. It comes down to this, Manis. It is a deterioration in the labor market that he's concerned about. He says, although it might already be too late to fend off a recession by cutting rates, dawdling now unnecessarily increases the risk. So it is a real risk in his estimation.
And just look at some of the data that we had yesterday. Richmond Fed, the lowest since 2020. Existing home sales down by 5%. So again, the fissures are there. This is bouncing from the inflation narrative to the dual mandate, which is about employment and the strength of this economy.
Right, and he lays out reasons why he thinks the Fed doesn't want to cut now. He says they want to build a consensus. They don't want to be fooled again, and they're not troubled by the labor market. It's that last point where he thinks that they should indeed be troubled by it.
Yeah, and inflation pressures have abated significantly after a series of upside surprises. So there you go, the pivot to the dual mandate. Danny.
Well, we're going to talk about the other pivot coming up, the rotation, buy into small cap weakness. That's according to Evercore's Julian Emanuel. He's going to join us next on Your Brief.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
This is your Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny in New York. Manus, we were just discussing Bill Dudley's op-ed in Bloomberg Opinion. I just want to go over it again. Here is the main takeaway from it. He writes, the facts have changed, so I've changed my mind. The Fed should cut, preferably at next week's policy-making meeting. He goes on to say he's concerned about the labor market and it might be too late to stave off a recession, but they need to act now in order not to make it worse. Joining us now is Evercore's Julian Emanuel joining us. Thank you so much for getting up early for us. Great to see you, Julian.
Good to be here.
Look, this is an opinion that's starting to pick up some steam, that the Fed needs to cut. They should be cutting now, and they should be cutting in some size. Put that together with me for what the pillar that means for small caps. I know you've been calling for the rotation for some time. It happened. You definitely deserve a lot of credit for seeing that coming. But put these two stories together.
So actually, it's a bit counterintuitive, but hopefully it'll make sense in a moment. Is that if you think about it, first off, the backdrop, Ed Hyman, who runs Evercore ISI, has basically been calling for inflation to cool for a year and a half now, more than people really expected, and that has certainly materialized. But the other part of that is the expectation that the historic tightening that we saw over the course of several years would in fact work its way through the system. So you are seeing, I think Bill Dudley is talking about the concept of long and variable lags, which is something that Ed has talked about for quite some time, really starting to hit. Where the intersection with small caps is, first of all, I mean, let's face it, small caps have been abandoned. They're like the child put in the corner.
Danny loves them.
I do love them.
Well, and actually, again, it is the time when an asset class has been abandoned as much as that, when it is trading at a valuation discount to history versus, you know, large caps and NASDAQ as it is, and when you have, in our view, policy behind you in an environment where even if we do have a downturn, it's likely to be a mild recession. That's an environment that we think is going to work, and we think the outperformance, and look, the drama of July's outperformance in small caps is really almost breathtaking. Obviously, the first couple of weeks was sort of to the good, and as the market has begun what we think is a broader correction at last week's high, you're still seeing that outperformance to the downside. But the thought is outperformance, and it's there, and we think it's durable.
I mean, you say very clearly the correction has begun in time and price, and on big caps, you're going to retest the 100-day moving average. But then if we look at this outperformance, just look at what happened yesterday in the tech sector, the big tech sector, on Alphabet, on Tesla, et cetera. Underwhelmed, and it's a perilous swipe at you. If these rate cuts look and feel as if they're going to come a little bit more quickly than we had originally anticipated, how much more flow will come into the Russell? Because we're seeing the flow pick up, we're seeing the price of the ETF pick up, and that flow, that momentum is there. So just describe the market flow for us.
Well, again, it is a very fine line, and we have to understand that because there are times, 2016 is a perfect example, where small caps outperform in a virtuous market cycle. We think it looks more like that, not coincidentally, an election year. And there are times, 2000, 2001, where small caps outperform because big cap tech underperforms. From our point of view, again, if you think about the liquidity backdrop, there is plenty of money on the sidelines to commit to both stocks and capital markets, and we think when this cycle is over, we are going to see a robust capital market cycle, M&As and IPOs. That's one of the reasons that the valuations here lead us to believe this is only a correction and not a market top. But again, the flow is probably a story that is going to go to the side. Probably till later in the year. Again, typically the time for market bottoms tends to be October, and I think given the volatility around this political cycle, you may see flows pull back a little bit for the time being.
Well, for the most part for this rotation, I know it varied a little bit last week, it has been small caps catching up. It's not necessarily been big caps selling off in a manner that would worry anyone. I wonder if yesterday changes that. And we don't have to talk about the individual stock, but just to lay it out, Alphabet, basically, their AI spend doesn't live up to what people had hoped. And this has been a large concern, that these hyperscalers have been spending a lot of money and that they need to show up with AI. Does the fact that some of these big companies, again, just one for now, don't have AI show that it might be different than it has been, that it actually might be the big cap techs taking a leg lower versus the rest catching up?
Well, the thing about AI, and actually this is a lot for those of us who are around, a lot like the introduction of computers to the desktop in the late 1980s and the early 1990s. The fact is that we as individuals have adopted AI into our own personal ecosystems to a greater extent than corporate America has yet. It doesn't mean it isn't going to happen. It just means it's happening a little slower than expected, and that time lag is basically what has been, in our view, over discounted at this point.
Look, we talk about the political situation the past couple of weeks, and I like what you referred to, which was 1996. We had an surety in 1996. This was Clinton versus Dole. It was so sure in the polls, and that's what we were building. We were all building that equity narrative around Trump and a GOP sweep. That narrative is challenged. That's the only word that I will use. I'm not here to make an opinion about it. It is challenged. How do you recalibrate on the new challenge?
Well, it's absolutely challenged. Look, again, if you go back...
You can have the opinion. We can't.
No, if you go back over the last year and a half, the public has been saying, whether you're a Democrat or Republican, that the one thing you didn't want to see was a Trump versus Biden rematch for whatever, and we don't have that right now. But the fact is that, and I think this has been misinterpreted by people, but this is a realism over 100 years of market history, is that unified government actually outperforms by 300 basis points per year over 100 years. And 2 weeks ago, coming out of that June 27th debate, there was a certainty about a red sweep.
Yeah.
And now that's certainly less so. And I think the straight line that the market climbed essentially since the April lows, it's part of the new political volatility, which is translating into technology stock volatility.
I just got to wonder, Julian, before we let you go, because we don't have that much time left, but as this election cycle goes on, we're going to get all these baskets that different banks are going to make and say, here are your Biden stocks, here are your Trump stocks, which I should say, a lot of those did not go as planned during the first presidency, where energy did not so well under Trump and did well under Biden. Should I be paying attention to those? Do we really understand the difference, the nuances of which stocks are going to outperform and which won't?
Well, again, this is varying degrees, and we have to write a new note calling them Harris stocks, by the way.
True, yes, good point.
We're still being presumptive. We're being presumptive about that. But in general, there are some differences, and I think the largest difference in what the market has been discounting was under a Trump administration and or a red sweep scenario, the regulatory environment is potentially likely to get more relaxed, which feeds into this idea of why financials had done so well in the last several weeks, because the thought is that M&A would, make a resurgence, and now that's something that is being retested again, as I said earlier. Ultimately, we think that cycle evolves under a Democratic administration or a Republican administration, but it's a different path to get there.
Well, one thing I think that we can all coalesce around is the fact that you're still going to have tariffs, you're going to have deficits, and you're going to have new rules on immigration. It's just a question of the scalability of those rules. Julian, thank you very much. Evercore's Julian Emmanuel, our guest this morning on the markets. Coming up, the Israeli Prime Minister heads to Capitol Hill. More on the visit of Netanyahu to the United States of America. Good morning from New York.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
It's your Bloomberg Brief with Danny Berger and Manus Cranny in New York. Let's set you up for your trading day on this Wednesday. We're going to get S&P U.S. PMIs out at 9:45 a.m. Eastern. Fed speak also comes from both Bowman and Logan at 4 p.m. Then earnings, IBM, Ford, Chipotle, all of them report after the market close. Plus, President Biden will be speaking at 8 p.m. from the Oval Office. Manus, it is his first address to the nation since stepping down from the ticket.
Yep, we're going to be all ears on that. Look, stocks that have dominated the past hour and will continue. Tesla extending its drop. The delay in the robo-taxi, I think, is one of the most prescient issues. Google extends its decline. The ad spending was good, but it was about AI. And Texas Instruments, Danny, extends its rally on the outlook, easing the fear of a chip slowdown.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The process of diversification is necessary, but you need exposure to these magnificent seven.
We want to be a little bit more defensive. It doesn't mean equities can't do well. It's the larger cap. It's the higher quality. It's because growth's slower.
In the small business sector in particular, the squeeze is quite intense.
In pockets of small caps, there's still a lot of opportunity.
Inflation's moderating, so it's an ideal scenario for the stock market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Wednesday with equity markets pulling back across the board on the S&P, on the NASDAQ, on the Russell. Check out the NASDAQ 100. Underperformance this morning off the back of disappointing earnings. We're down by more than 1 full percentage point. Switch up the board and get to Tesla. Missing expectations for a fourth consecutive quarter. Bramo, that stock is down by almost 8%.
And this is partly because the hope for robo-taxis is being pushed back again and again. It's partly because they miss yet again the expectations in the market. And it's partly because for the first time, it doesn't seem like there's a lot of enthusiasm behind some new product or new idea that's going to be put forward. The political angle of Tesla also becoming increasingly interesting.
Let's get into the political angle. Mexico, Elon Musk, quote, Trump has said he'll have to put heavy tariffs on vehicles produced in Mexico, so it doesn't make sense to invest a lot in Mexico. If that is going to be the case, there is an auto manufacturer making CapEx investment decisions based on the outcome of November.
You could see the political uncertainty is starting to affect business decision, Tesla being one of them. And this was a direct link. Really, for the first time, we saw Elon Musk. They've been slow walking this plant in Mexico. Now he's linking it directly to November 5th. So TBD, basically, whether or not there's going to be more money investment that plant opens, depending on who wins the presidential election.
Well, to me, I'm just looking at this. And first of all, you also saw margins compress pretty considerably because of some of the tariffs already in place as a result of some of the increasing trade war, number one. Number two, there is a real question about Elon Musk himself, who has supported Donald Trump for president, who has put a considerable amount of money, although a bit less than he originally pledged, to that campaign. Coming out, it raises the question, if the person he's seeking to elect has policies that might be negative for his business, is he being pro him in order to curry favor, or is he being pro Donald Trump in order for social reasons or something else beyond the economy that he views?
He was also asked about the subsidies for the Inflation Reduction Act, and this is what he said: it would be devastating for our competitors, and it would hurt Tesla slightly. He said the value of Tesla overwhelmingly, though, is autonomy. So basically what he's saying is in the short term, losing some of that IRA juice might hurt, but long term it might help us because it's going to hurt our competitors even more.
A difficult morning on the stock front for the likes of Tesla stateside. Over in Europe, LVMH taking a bit of a beating as well. Numbers yesterday afternoon, not fantastic. Their stock is down by more than 4%. I'll go through things for you line by line. Fashion and leather goods revenue, just plus 1%. Compare that to a year earlier. We were talking about double-digit revenue growth of 21%. Sales in the region, including China, down double digits. Do you want an extra political angle to all of this? Goldman Sachs on China. This is what they've got to say. The reason why they've been cautious on doing a lot of fiscal stimulus or demand-side stimulus is just that there is the risk of Trump. I think some of the logic is just let's save the ammunition in case we need to do a lot more in 2025. So if you're a luxury goods maker selling into China, hoping things pick up anytime soon, there is a nod from Goldman there suggesting that Chinese authorities are waiting also for the outcome of the U.S. election.
Well, and you just basically heard that. There wasn't any incentive in the recent get-together in China to really put forward or juice consumer spending. There also was a foreign exchange angle of this, which I absolutely loved.
Japan.
The fact that Chinese consumers were going to Japan to get their goods because it was a lower price because of the currency differential, and that was shrinking margins. It's just brilliant, frankly, of the shoppers from China, and I kind of envy it them.
Massive. Lift sales by 57% in Japan. Maybe your son was one of them. Also, thinking of the political uncertainty when it comes to the election, Bernard Arnault also came out in his statement, talked about the climate that's happening, the geopolitics. All of this remains uncertain, and Citi had this to say: no miracle with the luxury bellwether. The sector is likely to remain out of favor near term. So it feels like at this moment, it feels like this week was a complete election reset. We're going to hear from the president tonight. But also, companies are really starting to take into account that they need to wait potentially for some of these decisions or how their business might pick up till after November 5th.
The beatdown of European luxury has been quite notable over the last few weeks. Burberry got absolutely battered. Saw a similar story in Hugo Boss, if you still call that luxury, but that's a conversation for another day. Equity futures on the S&P 500 look like this on the S&P. Equity futures down by 0.7%. That was brutal, wasn't it?
That was.
Yields are lower by about a basis point, a 10-year. I used to wear Hugo Boss.
I was going to say, don't you wear Hugo Boss?
Used to.
I still do.
We've been to Hugo Boss together.
Used to. Long time ago.
Oh, it's not cool.
Things have changed.
What do you wear now?
We can talk about the quality. I'm not giving anyone an endorsement this morning. 424.27 on a US 10-year. In foreign exchange, the euro slightly weaker by 1/10%. 108.42, but I'm available for endorsements if you pay enough money. All right? I'm not. I can't accept anything. This is going too far. Coming up this hour, Greg Battle of BNP Paribas with big tech dragging stocks lower. Bloomberg's Jordan Fabian ahead of President Biden's address tonight, and Ben Callow of Baird as Tesla reports another quarter of disappointing profit. We begin with our top story, big tech driving stocks lower as earnings season kicks into gear. Greg Battle of BNP Paribas writing this: there has been some notable softness in some bellwether cyclicals. This is at odds with the macro narrative for Fed rate cuts driving a re-acceleration. Be careful what you wish for with softer data. It can become too soft. Greg, good morning to you. It's good to see you.
Thank you.
Let's start with this slide. Bill Dudley, former New York Fed president. I've changed my mind. The Fed needs to cut rates right now. He's looking at the labor market. He says it's time to go. That's a big change for him. What do you think?
Yeah, I mean, the thing about Fed cutting cycles and what they mean for equities, they're difficult to navigate because they mean one of two things. Either the Fed's cutting because it can, because inflation's benign, that's generally good for stocks, or it's cutting because it has to, because the data's slowing down a little bit too much, and that tends to be more negative for stocks. So that's the question we have to answer.
Can you answer it?
Well, I think earnings season is what we're going to use to answer it, and we're going to see how that progresses. Now, we're still early in the earnings season, but so far it hasn't been great. So I think there is some evidence that some of that slowing in the macro data is starting to feed through to corporate earnings, and that creates a less constructive backdrop for stocks.
Part of this is by design. We were talking about this yesterday, that essentially it is the Fed. John Stoltzfus was saying you can't really look at this and be surprised because the whole point was to slow down the economy in order to get weaker inflation. What's your argument that says it's a pernicious enough weakening to cause the sell-off in equity markets that you're expecting to get down to 51.50?
Yeah, I mean, honestly, it may not. So we have to wait and see how the earnings unfold. The year-end target we have 51.50, we set back in February when it was above the current spot market. So what we've seen is the market overshoot, and we've seen an extension of PE multiples, high teens rally from equities, and essentially what we think we need to see is a bit of a re-acceleration in earnings to take the market higher from here. Based on the evidence we've seen so far from earnings season, that doesn't seem likely.
There is this political angle to it. We were just talking about how this earnings season has actually shown companies are truly postponing decisions in order to wait for the political tides to come into clearer focus. How much does that also diminish the possibility of a reacceleration of earnings, just simply because there can't be that many big moves made if there are these sort of potential tariffs or potential restrictions or potential regulatory pressure that could come to the fore?
Yeah, I'm not sure how much market participants are wary of the election. You can look at what's priced in by the volatility market specifically for the election, and that's at the lowest levels that we've seen during this election cycle. So if anything, some of that election fear has been dissipating as the polls have been shifting. And I think if anything, it's been driving some of the pro-cyclical rotation, the outperformance of the Russell that we've seen over the last month.
A lot of people actually are looking through the noise. You think politics is moving the rotation?
I think so, but I think it's one of many things, so it's hard to disaggregate. So what we've seen is positioning reach extreme levels, with Russell and the cyclicals being very unloved. And then we had this very soft CPI print, which acted as a catalyst to see those parts of the market that also rallied in November and December rally again as that cutting cycle got more firmly priced, kicking off in September. Now, those are also the trades that people tend to associate with a Trump presidency. So it's quite hard to distill how much of those three drivers is contributing to the move, but all three of them are.
So the three pillars that we keep going back to on this program, one is politics, the other is rates. We've got to talk about the economic data and the earnings. You're reading into the economy based on the earnings. I think that's interesting because I find it really difficult to read into the economy based on the earnings at the moment.
Yeah.
We had the conversation at the start of earnings season that Dow was pretty good, or rather pretty bad. Pepsi was pretty bad. And then yesterday, GM was pretty good. Coca-Cola was pretty decent. Which one gives you a better read of things right now? What do you look to?
I guess the price action from GM wasn't that great, even if the numbers were. So I think that there has been a little bit of something under the surface in earnings season. There's a little bit of a market cap bias. Some of the bigger stocks have done better than the smaller stocks, which is the opposite of the price action we've had coming in. I think there's a little bit of softness in the more cyclical stocks. So if you look at the consumer, many of those names you mentioned earlier, you look at UPS, there's a bit more softness, I think, in some of the cyclicals. So I think we'd be careful looking broadly at the earnings season, large cap tech and the defensives to get a read on the economy. It's the cyclicals that you probably want to focus on to get more of a macro read.
Going back to how we started this conversation, do you think we do run the risk of being on the wrong side of this rate story? That they're cutting rates because the economy is already decelerating, and that re-acceleration that people are positioning for in small caps ain't going to happen?
It's definitely a risk. So I think one of the things that we've been saying is that we are at a point now where obviously we've had massive outperformance from the large caps, the AI bellwethers. We've now had this squeeze higher in things like the banks and the small and mid caps. So what we're at risk of, if the data does slow more than most expect through Q3, Q4, is that you can get a more correlated sell-off. More correlated sell-off is ultimately what could see volatility spike and the VIX reset higher.
Just going back to your year-end target then, to get there, because you are kind of bearish on the market, and you have been for quite a while, I'm just curious if what we have seen so far, the preliminary look at big tech, is enough to give you a renewed confidence that we're going to get there, that could be what leads us down, even if it's in tandem with growth concerns?
No, I don't think so. I think what we need to see is a more material slowing. So clearly we haven't had much of large cap tech report this season to date. What we have seen is probably a little bit softer at the margin, certainly in terms of the price action. But I think to get down to that kind of year-end target that we have, you need to see a more pronounced slowdown, both in the macro, and you need to see a little bit of a downgrade cycle emerge post-earnings.
Greg, good to catch up with you, sir. Greg Battle of BNP Paribas, with plenty of thoughts on this earnings season and what it might mean for rate cuts later on this year. Bill Dudley, former New York Fed president, making some headlines here at Bloomberg on Bloomberg Opinion, writing, "I've changed my mind. It's time to act right now and reduce interest rates. The facts have changed. I've changed my mind. The Fed should cut, preferably in next week's policymaking meeting, although it might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." I wonder if that gets presented at the FOMC next week and they read out that first couple of lines.
Well, he has a good track record, and maybe if they had read him out a little bit earlier, they would have gotten a 5% Fed funds rate a little bit earlier, because that's basically what he was projecting. What I find interesting is he highlighted that the waning of some of the effect of the Biden stimulus seems to be coming more into fore. In other words, its power is kind of running out more quickly than he had expected, and not necessarily offsetting the restraint that you're seeing from the monetary policy. So So that aspect, I think, is what's really kind of getting him a little more worried.
I'm picking up on that as well, because he's talking about these vast investments the Biden administration made, whether it's the Chip and Science Act, Inflation Reduction Act, the Hard Infrastructure Act. And if that's what you think, and potentially that demand has started to wane, then the Fed would be cutting sooner. And you can paint this back to politics two ways. One, there was an issue because of maybe there was too much fiscal stimulus in the market. And then secondly, that means maybe one, if Dudley is correct, or two, cuts before the November election.
We'll get some thoughts on those Dudley comments throughout this morning. Equity futures on the S&P 500 negative here by 0.7%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Deutsche Bank has reported its first quarterly loss in 4 years as trading slowed. The German lender also booked a charge tied to a legacy issue at one of its retail units. CFO James von Moltke told us that the bank is likely scrapping buybacks for this year.
This year, I think prudence would dictate that we step back from seeking a second repurchase authorization. We've already returned, 1.3 billion to 1.5, billion to investors so far this year, and so we think we're demonstrating an ability to stay on track.
Shares of Deutsche Bank falling by more than 5% in Frankfurt trading. Meanwhile, shares of LVMH are also slumping in the French trade. The company reported a slowdown in sales growth in the last quarter. Shoppers reined in spending on luxury. The big hit, though, came from China, which saw sales in Asia, ex-Japan, fall 14%. Meanwhile, there was larger growth in Japan, which saw an uptick in tourists. LVMH's CFO said that customers were simply saving up, waiting for their next trip to Japan, thanks to the weekend. All eyes will be on President Biden tonight. He's set to address the nation from the Oval Office at 8 p.m. Eastern. This will be the first time he's spoken since he dropped his re-election bid on Sunday. Former President Trump, meanwhile, is demanding equal time. The New York Times reports that he sent a letter to 3 major networks arguing that Biden's speech will be a primetime campaign commercial for Kamala Harris. Trump will hold a rally in Charlotte, North Carolina this evening, 2 hours before the president's address. And that's your brief. John.
Danny, thank you. Did you see him playing golf with Bryson?
I did.
Quite cool, those videos, you know.
Yes, I know. And that will get a certain cohort who likes watching golf on
Yeah,
Sundays.
I mean, like, decent golfer.
Yeah.
Decent golfer. Not a 6 handicap or an 8, you know.
Was he basically trying to get Kamala Harris on the course?
I think he's still trying to get Biden on the course. He can't let it go. Like, you listen to some of the comments, he just can't let it go. Up next on this program, a new election taking shape.
So hear me when I say, I know Donald Trump's type. And in this campaign, I promise you, I will proudly put my record against his any day of the week.
Conversation is coming up next, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Also not sure what I think about of LVMH and the CFO saying that people aren't buying enough stuff because they're saving up to go to Japan again.
Well, what I think is that this is actually brilliant. It's a fantastic FX trade, and frankly, if you can, go for it, because why not? I mean, you're basically buying it on a discount, and that's the reason why LVMH's profit margins are shrinking.
If you can afford just to go on vacation to buy LVMH, then I'm not sure how long you're saving up to go to Japan again.
Okay, how do you explain Taylor Swift flying to Paris or flying to England in order to see Taylor Swift? It's the same kind of trade.
Tickets are much cheaper.
But it's a very similar analogy.
Yeah, but do you think the Taylor Swift audience is the same as the LVMH buyer?
No, but it's a similar kind of
There's
concept.
got to be someone in the middle in the Venn diagram.
These people are like dropping tens of thousands of dollars on leather goods at any given time. You've seen this in the store, it's amazing.
Well, if that's the case, then what's an extra $1,000 to fly over there?
That's what I'm saying. Do you need that much time to save up? Probably not, right? Anyway, whatever.
Let's move.
Futures. We agreed in the end. You disagreed, and then okay. Futures, negative by 0.7%. Yields unchanged, the 10-year 424.47. Under surveillance this morning, a new election taking shape.
So hear me when I say, I know Donald Trump's type. And in this campaign, I promise you, I will proudly put my record against his any day of the week. I am so very honored, and I pledge to you, I will spend the coming weeks continuing to unite our party so that we are ready to win in November.
Here's the latest. Vice President Kamala Harris holding a 2-point advantage over Donald Trump in the latest Reuters poll. That's compared to the 2-point deficit President Biden was facing just last week. Biden addressing the nation at 8 p.m. Eastern Time. It's the first time we'll hear from the president since he dropped his re-election bid. Bloomberg's Jordan Fabian joins us from D.C. for more. Jordan, 8 p.m. Eastern Time, the president addresses the nation. What do you expect to hear?
Well, we'll be looking for his explanation of why he dropped out of the race after, saying only the Lord Almighty can force him to do that. And also, what message is he sending to the nation about Kamala Harris, the person he picked to be his successor? Those are two of the big themes we're going to be looking for in that address.
Jordan, why did it take him so long to appear in front of a camera to the American people?
Well, a big part of the reason, Anne-Marie, was Biden came down with COVID last week. On Thursday, he was in isolation over the weekend when he popped out that statement. But it is odd that, he did not, appear personally to make this huge momentous announcement that really changed the contours of this race. And, there's been a lot of conspiracy theories, too, on the right about Biden's well-being. And so the address is also an opportunity to reassure the public he can serve out his term, in addition to all the other things I listed.
We heard from Tony Fabrizio yesterday, Trump's campaign pollster, and he said the Democrats deposing one nominee for another does not change voters' discontent over the economy, inflation, crime, the open border, housing costs, not to mention concern over 2 foreign wars. He's calling what's happening in the polls right now that John referenced a honeymoon for Kamala Harris. How are you reading this, how Trump's camp is trying to prepare for a brand new campaign?
Well, there's some valid points in that memo, but, it shows to me that they're a bit worried about Kamala Harris. Keep in mind, Anne-Marie, that this is coming off the heels of the Republican National Convention and an assassination attempt on Donald Trump. Those are two events in which you'd expect a huge boost in the polls for Trump. Why is he not getting that? I mean, why is that not accounted for in that memo? And also the fact that they prepared their whole campaign to go after Biden and concerns about his age and acuity. This shows that they're kind of throwing spaghetti against the wall when it comes to Kamala Harris. They haven't settled on a message to counter her yet.
And now we have Donald Trump being the oldest candidate ever for president. So the table's being turned on him. There's been a real question around the vice presidential pick and whether that was a mistake for the Trump campaign, whether J.D. Vance is the wrong person to really galvanize a lot of voters. What's the likelihood from the people you speak to that there could be a replacement of J.D. Vance?
Well, I think it's too late to do that for the Republicans. He was nominated officially at that convention just a week or two ago. So he's on the ticket. They can't take him off, even if they regret their choice. And then looking ahead to what Kamala Harris has to do, she's maybe not wanting to fall down the pitfalls that Donald Trump had. She wants to perhaps pick someone who complements, her style, her strengths with someone else. There's been a lot of speculation about, white male governors. And so that's making up most of the list of who she's looking at.
Except for one, who is a senator in Arizona and seems to be the front runner. Is there any sense that you're getting in terms of who that person is most likely going to be?
It's not clear that she's narrowed her list yet, but it is only about half a dozen people, in addition to Mark Kelly, who you just mentioned, Lisa. There's the Governor Josh Shapiro of Pennsylvania, Governor Andy Beshear of Kentucky, and Governor Roy Cooper of North Carolina. Those are the really core that we've heard speculation about, the hottest about who she might go after.
Jordan, she's going to be at an event today instead of listening to Benjamin Netanyahu. Is this the right decision for the start of her campaign, especially given the fact that she doesn't have a tremendous amount of foreign policy experience?
Yeah, it's a good question. She had a couple of previously scheduled events, so she's going to be out of town. She's going to be meeting separately with Netanyahu on Thursday, is what we're told. So, look, I think on one hand, yes, you'd like the opportunity for her to be in the room to get those photos. On the other hand, U.S. voters, as much as we care about foreign policy, U.S. voters aren't as tuned into that. And so for the opportunity for her to go out into the country, talk to voters, might end up paying off more in the long run.
Jordan, just before you go, an assessment, please, of Trump's golf game. What do you think? Putting stroke's a bit weird. I know a lot of people are saying the same thing. What did you think?
Yeah, the putting stroke is what got me, Jonathan. Left a few 8-footers short for my taste. But, as you said, decent golfer, but he says he's a 2 handicap. I'm not sure it's quite there.
Jordan, thank you, sir. Jordan Fabian there of Bloomberg. Fantastic exchange with Bryson DeChambeau and the former president, Donald Trump, if you want to tune into that on YouTube.
What does it say about our political sphere that the most authentic and passionate conversations that anyone can have in politics
Around
right now
the golf course?
is about golf?
What's new about that?
I mean, well, I don't know. There was a time, I just couldn't think back to some of the speeches that were published from the 1800s. They weren't talking about people's golf game, I'm just saying.
You know what? I think that's why people found it quite refreshing the other day to hear from Kamala Harris. It was just a normal political speech. And you might have disagreements on policy, and everyone's perfectly entitled to have those disagreements, but it just felt normal. It was somewhat refreshing. We haven't heard something like that for a number of years in this country.
She got up, she was sticking to the script, and she didn't go off veering about things like sharks or Hannibal Lecter like Trump does, but she was able to finish her sentences unlike Biden's able to do.
Yeah.
So in the sense, this was just a normal person reading a speech, delivering a message, and that a lot of people enjoyed.
It's how low the bar has been, right?
But this is exactly it. And to me, this is sort of, we talked about, what was it, boring competence over in the UK, and is that essentially what people are looking for right now in the United States too, because they've been rather shell-shocked from some of the alternatives.
Is that what we're calling Sir Keir Starmer for his Prime Minister? Boring confidence.
Competence. Yes, well, that's what some people, it wasn't just me.
Okay. All right, I'm just wondering. Wondering.
Not exactly, fireworks.
Not at all. Coming up, you don't want my opinion. Tesla's earnings falling short once again. That stock is down about 8%.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Equity futures on the S&P 500 shaping up as follows. We're down across the board. We're down by about 0.7 on the S&P. On the Nasdaq 100, down by about 0.9. Bear in mind, Tesla, Alphabet make up about 8% of the Nasdaq 100. Those two names not faring too well in the pre-market. More on that in just a moment. If you switch at the board and turn to the bond market, we'll sit on the 10-year. Just check out the 10-year yield this morning. The yield just a little bit lower by not even a basis point, 4.2447. Bramo, give us the numbers. I know you've got them to hand. Supply this week.
$70 billion at 1 p.m. today of 5-year notes. And tomorrow we've got $44 billion of 7-year notes coming to the fore at 1 p.m. Eastern. Yesterday, I just want to say the 2-year auction went very well. It was oversubscribed or whatever, like it was overbid. And basically, people are looking to this idea that the Fed's going to cut sooner, partly because of the cooling economic data. So how much of a bid into duration do you end up getting, especially with the risk-off feel that you're seeing right now, led by big tech?
How much tension do you think there is between the story you just described and the fact that credit spreads are still really, really tight in high yield? Is there some tension there for you?
I would guess that theoretically, yes, because theoretically you would see credit spreads widen. There is a story in the credit world, which is that essentially over time, the credit quality of a lot of these names has increased dramatically, and the U.S. is attracting a lot of international money simply because the all-in yields are so much higher. So that's sort of a natural bid into credit that's suppressing yields. But correct, it is a little bit odd that you're not seeing investors demand a greater premium for the risk of default at a time when people say that the economy is deteriorating at a rapid clip.
Winnie Caesar of Credit Sites joining us a little bit later on the program. We'll have that conversation with her. I want to turn to foreign exchange and look at dollar yen. Every single day this week so far, so that's 3 days, Monday, Tuesday, Wednesday, stronger Japanese yen. Dollar yen now in the 154s. Lisa down by 0.6. We're back to about 154.60.
So I went looking for the reasons for this. Why exactly is this whole reversal happening? Why are people pushing back from some of their bearish views in the yen? All I could get was positioning. People kind of getting stomped out of carry trades. People basically trying to reassess heading into a couple of months. It feels as though this is more of a technical trade based on everything that I've been reading and hearing. And basically this idea that the dollar maybe is losing some of its prominence, sort of unwinding of the Trump trade, whatever you might think it was. And that seems to be more of the explanation than anything else right now.
The strongest Japanese yen since about May time of this year, after hitting the weakest levels since the 1980s. Which just gives you an idea of where that currency's been. Under surveillance this morning, our top story, flight cancellations once again continue for Delta following Friday's global IT outage. U.S. Transportation Secretary Pete Buttigieg saying the airline is now facing an investigation after more than 3,000 passengers filed complaints. Delta faring the worst among U.S. carriers. Most other carriers, most other airlines are back on track over the weekend. Something different happened with this one. What happened with Delta?
It was the flight crews not being able to figure out where they should be. Mild problem. Also, you heard about actual pilots and flight crew members being annoyed that they couldn't call anyone at Delta to find out where they should be. I mean, this is sort of a widespread failure because of the way that they were using the CrowdStrike applications, related applications. The interesting thing to me is that only 3,000 people filed complaints, because there was something like 4,500 or 5,000 people who actually had their flights canceled. Have you never had your flight canceled, been stranded somewhere, not get a voucher for anything, had to suddenly pay a whole amount of money to basically house and feed yourself for a couple of days, and you don't even know who to call? If you had a number, wouldn't you call? I'm just saying.
I'm struck by what the pilots have to say, the feeling they feel abandoned by the system. Also interesting, today by 5 p.m., the CrowdStrike CEO needs to return to Congress to schedule that hearing. He has till 5 p.m. today with those congressmen in the House to schedule the hearing, because they want to know what happened. Not just because people are stranded, pilots feel abandoned, but also the national security concerns of what happened with CrowdStrike.
We've seen some tough grillings on the Hill over the last few months. I'm thinking more recently of maybe the Ivy League professors getting torn to shreds, or at least the heads of those Ivy League colleges, then more recently the head of the Secret Service. I just wonder if that's going to be the same thing that a CrowdStrike CEO has to face, and how well that CEO is going to deal with that. I've got that quote from the Pilots Union right in front of me: the inability to contact the company in any capacity. That's scathing, Bramo, scathing.
Well, and it highlights just how intricately some of these programs were worked into their system. There is a bigger question here, which is how do companies, how does a nation immunize itself from such dependence on one application in a way that could potentially torpedo its entire system? Yes, there will be a grilling with CrowdStrike CEO, but there is a larger question about how much we depend on specific companies and applications that could be systemically important and potentially destructive.
We'll have more on the airlines, on Delta specifically, a little bit later in the program. I want to turn to the other earnings story this morning. It's Alphabet. It's down in the pre-market, a little bit softer. The numbers weren't too bad. The stock is down by 3%. Even if the numbers from the Google parent company reporting second quarter revenue and sales that actually beat estimates, but seeing weaker than expected performance from the likes of YouTube, the company also facing lingering questions over its performance against AI competitors. We caught up with a guest yesterday who said that maybe in line was the new beat. Based on that price action, I'm not sure that's the right way of seeing things.
I was actually, one thing that I wrote, in line is the new miss, at least when it depends on what the line items are. When you look beneath the hood, because they beat across the board on the top line levels. You look under the hood, what were the misses? YouTube revenue, and there was an increase in spending on CapEx related to artificial intelligence. This issue really highlights how people want to see where artificial intelligence is going to produce profits. If you can't see that path, this is the same Google that was really there a year ago when people saw it as an ad spend and a search company, and that's essentially what it displayed in the recent earnings.
Earnings season for mega cap tech very much underway. Let's turn to Tesla. Shares down in the pre-market by close to 8% in early trading with negative 7.7. The EV maker reporting another quarter of disappointing profit and confirming it's postponing the highly anticipated launch of its autonomous robo-taxi. Ben Callow of Baird has an outperform rating and 280 price target on Tesla, and I'm pleased to say that Ben joins us now for more. Ben, in some ways, Elon Musk tried to make it very simple for us all. Either you believe in the robo-taxi business and you should be in this name, or you don't and you should sell. Ben, do you see it the same way? Is it that simple?
I think that there is some truth to that. I also think that we have some more near-term things that we can hang our hat on. The next generation vehicle, which we do think will be unveiled at the Robotaxi event. Tesla hasn't had a new vehicle on the road outside of the Cybertruck in that small volumes in several years. And so as we get a more mass market vehicle or vehicles as early as next Q1, I think that will be a catalyst for the stock. And I think that, reiterating the timeline around that vehicle was a very important part of the call last night. It was a bottom line miss. The margin, people are going to argue over regulatory credits, and they beat on the margin. If you had the regulatory credits, they missed. If you didn't, their experience, there's some pain that the other auto manufacturers are also experiencing. Tesla does have the balance sheet over $30 billion. They managed to generate, over $1 billion of cash flow, even with investing $3 billion of CapEx and R&D during the quarter. And so, I buy the dip here because we're set up for, many different growth opportunities, energy, Optimus, full self-driving, and then the next generation vehicle.
Let's talk about the slippage around the timeline for autonomous driving and the robotaxi specifically. Let's go with the robotaxi. It was meant to be unveiled in August, Ben. It's been pushed back to October. We had that reporting in the last couple of weeks, basically confirmed yesterday in the release. Ben, how material is that for this company? Because I've been describing it since April as the carrot over this stock, and maybe the people doing so, including myself, were wrong, because it was been pushed back, and it doesn't feel like that's the big driver here. How important is that to this story at the moment, Ben?
Well, Dana Hall and Bloomberg did a very good job of breaking that story. I think at the bottom line, though, it pushed out 2 months, and I think it was a twofold. One, they wanted to tweak the robotaxi itself and the platform, so needed more time in that. And then also, like I mentioned, the next generation vehicle, it matches with their timeline of getting those cars out on the road at the beginning of next year. So to unveil it in October makes more sense than in August, where you have the potential to damage sales of the Model Y and the Model 3 with introducing a better new product. And for tech companies and tech investors, you want to be buying ahead of new product cycles, and we're right here in front of a new product cycle.
There's a question also about how quickly it can get rolled out in any kind of mass to create the profitability that a lot of people would need to see. There are concerns about regulation, especially with full self-driving as well as robotaxi technology. In response to that, Elon Musk on the earnings call said this: "I don't think regulatory approval will be a limiting factor." Do you agree? Is it not a concern to you either?
Well, first, just the rollout, we expect it to be, in select cities, and Tesla-owned fleet. So taking small steps, but those small steps will have big implications for valuation. As soon as investors can wrap their arms around what this is going to be, start modeling it out, and then see the future profits that can be generated from this, then they start ascribing a valuation to it. We don't actually do that in our price target in our model. And so when we get there, we get a framework for it. I think even though starting small, might disappoint some people, I think it will also attract a lot of investors that can start, dreaming the dream that is becoming more of a reality every day.
Ben, we heard Elon Musk weigh into politics again last night. He said Trump has said that he'll put in heavy tariffs on vehicles produced in Mexico, so it doesn't make sense to invest a lot in Mexico if that's going to be the case. Who do you think is better for Tesla in the White House? Kamala Harris now or Donald Trump?
Well, I think that Elon has put himself in a position where both are better. Both are good. He has strongly endorsed Donald Trump. He has donated to a PAC supporting Donald Trump. And so he has the ear of Donald Trump. And so as it pertains to renewable energy, as it pertains to electric vehicles, he has that ear. And you've seen that Donald Trump has changed his tone quite a bit since that endorsement. Saying that he likes EVs, and that was, a far cry from what he was saying a couple months ago. And then Kamala Harris, as part of the was part of the Biden administration that put in arguably the largest energy plan that we've had, at least in my lifetime in the Inflation Reduction Act. And so I don't think, I think that will stay status quo. And so that, I think they can thrive under both administrations.
Ben, I want to just dig a little bit deeper into that. Are you basically saying that Elon Musk's support of Donald Trump has essentially succeeded in creating him favor so that if Donald Trump becomes president, any types of policies that a lot of people think could potentially take away certain benefits for electric vehicle makers would get rolled back, at least for him, and that tariffs wouldn't be as punitive?
Well, I think that, one mistake that the Biden administration made was, they never visited Tesla because it's not a union. They visited other auto manufacturers in the United States. I think having an administration that is open to talking to Elon Musk is better for them. I don't think that, they're going to favor, Tesla over other auto manufacturers in any way. They may tighten up the way that, materials need to be in the United States, produced in the United States, whether it's lithium or other materials. And Tesla has already taken those steps to move their supply chain into the United States. So a domestic supply chain that I think would thrive under the Trump administration.
Ben, thank you, sir. Appreciate your view. Ben Keller there of Baird. The takeaway, he says, buy the dip. The stock is down by close to 8% in the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Santander shares are rising 1.5%. The Spanish lender reported net income for the second quarter that beat expectations. It also upgraded its outlook for efficiency and revenue growth this year. The bank is on track to roll out a new tech platform that's intended to lower costs across all units. Spain and Brazil boosted results for their key retail business. Brazilian locations in particular benefited from rate cuts. And what's old is new again. Apple is reportedly working on a foldable iPhone that could be released in 2026. Tech news outlet The Information says the firm had reached out to suppliers in Asia to make components for the device. The phone would reportedly fold widthwise like a clamshell, making it similar to the Samsung Galaxy X Flip, which was released in 2020. The report says that Apple had created an internal code for the product, signaling that the idea has moved beyond the conceptual stage. And there is some good news if you're still looking to travel to Paris for the Olympics. According to travel insights company Lighthouse, hotel prices for the Summer Games have fallen to almost half of their peak rate. Accommodations are now being listed on average of $340 a night between this Friday and August 11th. That's down 41% from the peak rate of $575 around 11 months before the Games. Opening ceremonies are this Friday. And that's your brief, John.
Danny, thank you. Next to no interest in being in Paris for the Olympics. No interest at all. And clearly, based on the hotel prices and the trajectory for them, people share that view.
Well, they aren't as interested as people previously thought. They're still high, and people, there's one person, Jim Reed over at Deutsche Bank, talked about how he's going, but he's not going to waste.
Okay.
Yeah, he's going to bring his family over the weekend.
And the prices of LVMH goods in Paris versus you could be going to Japan instead.
Exactly. Or Italy. I always think that. I'd rather go to Italy. Like France's budget Italy. That's how I feel about France.
I actually was looking at some of the events.
Not interested.
That's pretty harsh, but I will say table tennis, judo. I was looking at some of the events that you could go to. There's a wide panoply of potential events.
There we go. We'll check it out. Try and get some tickets, Bramo. Team tour. TK would love this, wouldn't he? He'd make it happen. Up next on the program, big tech facing big expectations.
Over the next kind of 4 to 5 months or so, expect to see some bumpiness, some consolidation, at least from some of those tech gains out there. Certainly kind of gotten a little bit ahead of themselves.
That conversation up next, live from New York. You're watching Bloomberg Surveillance.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. Go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Equity futures on the S&P 500 negative here by 0.7%. A couple of disappointments out there. We'll talk about them in just a moment. Under surveillance this morning, big tech facing big expectations.
Over the next kind of 4 to 5 months or so, expect to see some bumpiness, some consolidation, at least from some of those tech gains out there. Clearly kind of gotten a little bit ahead of themselves. As we kind of start exiting the calendar year here, we think there will be kind of another boost up there, a next leg up here for big tech. But right now, I think some consolidation is probably warranted.
So here's the latest. Shares of Alphabet